What's up, everybody? Happy Monday. Yes, greetings. Girk, open the market. Ah, that's not how. I can't just do that. 1 second. All right, there we go. Why stocks frozen? Well, futures are trading today, but yeah, nothing else. Markets are closed. You're welcome, Carl. I'm glad I could do that for you. I finished reading Best Loser Wins last night. You can read? I did not know that, Farmville. Well, congratulations. I like the macro tweet with the Fred charts. Good job, guys. Thanks. Can you go over bond vol convexity a bit? What about it? I could, maybe later. I mean, I'll cover it before the end of the stream. It's been getting a bit touchy as of late. Great book. I finished it a year ago, and I still feel like the bestest loser. How would you normally look versus where it is now? Why that matters. Okay. Yeah, I can do that. Do we have any news out of the Fed this week? We do. We have minutes, FOMC minutes on Wednesday. Yeah, we could start off with that and kind of cover what we're going to be looking at this coming week. I don't think we have. I don't think we have a lot of data um, in the first part of the week at all. I think I have a 1 year auction on Monday. Uh, Chinese lending facilities tonight at 8:15 p.m. Rate cuts have been expected there for quite some time. There still haven't been any. There probably won't be any. There's a 20-year JGB auction tonight. Then not much till Wednesday. Yeah, so pretty light on the data. I think Monday and Tuesday are going to be driven pretty much by positioning or the breakdown in positioning, which we'll get into in a minute. Wednesday we've got some mortgage stuff. Red Book speakers. I got a 2-year FRN and a 20-year auction at 1 o'clock. All of that preceding the FOMC minutes, which come at 2. We got some Japanese PMI, then we EU PMIs, and then we're gonna get some US PMIs, some jobless claims, Chicago Fed. We're gonna have a 30-year tips auction, which should be kind of interesting. And then next Friday, German GDP final for Q4. Maybe the most important thing that day. So pretty light on the data, with the exception of Wednesday, Thursday this coming week. The rest of the days, not much going on. I don't think we get a dot plot. That should be the March meeting, but we You know what? I really don't think we're gonna get much out. Maybe some changes in. Maybe we get some changes in their like standard statements. But I would say that's the only thing I really expect out of the minutes. Yep, we do have Nvidia earnings this week, and that will be a big deal. Are DGI, SPX, and NDX all topping out together? I mean, I don't know if they've topped out yet, but they're all kind of up together. It really depends on how you look at them and in what context. NQ is the clear leader, or Nasdaq 100. Um, I would say Dow's trailing, and SPX is kind of in between the two. But if you take out like the Mag 7 from any of those, what you're left with isn't nearly as promising. Most of the performance across all of the indexes is linked to this. I mean, besides Russell, right, is really heavily linked to the performance in tech. And like SPX, if you remove the Mag 7, is trading at like an 18.1 forward PE. Um and is down 10%. So, I mean, yeah, it's pretty much still just the Mag 7. If those are going to continue running or not, we'll see. I mean, obviously, Wednesday, Nvidia earnings are going to be a very, very big deal. They are kind of the linchpin that holds the AI narrative together. You think inflation has bottomed and will continue to surprise to the upside? I think we've got a few more months, yeah. Um, the Red Sea conflict. I don't know if you guys saw this article over the weekend, but one of the U.S. admirals came out and said that the Red Sea conflict is already the biggest naval battle that the U.S. has had since World War II, and I kind of buy that. At least as far as deployment of our navy goes, and allied navies as well. I know Germany and Great Britain both have a presence in the area now as well. Um, so that really started beginning of December, and the effect of it and the increase in shipping costs started to be felt, almost right away. Now I figured this would take like 30 to 60 days to really accelerate. But from the first PCE report we got after they began, we started to see a slight uptick in some durables costs and a little bit higher core rate. Then that accelerated with CPI. Then we got a hot PPI print. Right now we just got a really hot CPI PPI. So we'll see if that starts bleeding over into personal consumption even more. It probably will, right? All of the increases in producer side costs have been immediately and multiplicatively felt by the consumer, right? Americans are simply paying a lot more money for a lot and getting a lot less. Sales are down, revenues are up, which I mean really tells you that all corporations are just in pricing inflation forward. And those costs continue to rise. The disruption in the Red Sea has not ceased. I know Maersk is still rerouting, and a few of the major shippers out of China. We'll see. That I think that'll be really important now that the Chinese New Year is behind us. We're gonna have to see what shipping prices look like out of China. If those stay elevated, which they're likely to, we're gonna start to feel the impact of that increased cost even more. So yeah, I would say that we're on a pretty good track for 2 to 3 months of rising inflation. How fast that's going to rise, I have no idea. Um, it could be very very rapid. It could be slowed by the Fed fund rate. I don't think the Fed fund rate has had a lot of effect on inflation over the last year and a half. I think it's kind of just the slowing of the fiscal impulse that has driven inflation down and the easing of supply chains. But this directly affects those supply chains, and so there's a possibility that inflation spikes, hard, back to like early 2022 levels. That's definitely not out of the question. Uh, Obviously, this isn't as bad as the supply shock from the pandemic and from Russia or the war in Ukraine. But it's more persistent, right? Those were kind of like one-off events, and this is constant. It's a constant increase in shipping costs, and I think we did some napkin math on it, the other day, and it's like $100 billion in inflationary pressure every day that it continues, and that's going to compound. So yeah, I don't think we're going to see inflation coming down anytime soon. Also, in May, healthcare costs, which are now higher due to the adjustment in seasonal weighting, are going to re-weight against a higher average. So the base value is shifting forward from a period where healthcare costs were down year over year to a period where healthcare costs are up year over year, and that base effect is going to lift healthcare costs, which are now more heavily weighted, and that's going to happen in May, and that could drive a lot of pretty significant increases in PCE. So yeah, I think we're headed for a period of heightened inflation. I think the Fed knows that. I think that's why the Fed has held on to their ability to increase rates, because they may need to. What's the indicator you have on with the orange line on the bottom? Red, white in the center, yellow, shaded white, blue. I don't know what the hell you're talking about. Come on, Greg, play Nvidia earnings. You know you want to. I might get like a strangle on it, just because every time that I've shorted it and hedged the upside, I made a shitload of money on the hedge. This one's particularly important. I don't think it's gonna trade flat like it did the last two earnings. So yeah, I'm kind of excited about it. Good morning from our SoCal downpour. We're building our neighborhood arc if you need me. All right, noted. What's the likelihood of breadth just improving across the market and we keep going up compared to a volatility event causing a 10 to 20% correction? I don't think we're going to see breadth come in. There doesn't seem to be any solid base case for it right now. Russell still looks weak despite its breakout last week. It is over short, so it tends to be a bit sensitive. But yields aren't going down, which kind of strips away the bull case for mid caps and small caps. And a lot of them are going to be facing a pretty big wall of debt maturation over the next 2 quarters. So if rates are going to persistently stay high, that's really bad for small and mid caps. So I would say it might be roughly equivalent. A credit event should not be considered a common possibility, right? Like, I would say we're closer to one because the market's over leveraged and everyone's kind of in at the top. We're not. None of the things that they wanted to happen are happening, right? So as that bull case gets stripped away, we're probably going to see a pretty big loss in confidence. But I mean, I'm not really sure how much that matters. We've seen the markets, driven by forces well outside of the average investor's sentiment for quite some time now, and that may not change. So I don't think we should bank on a credit event being something that's likely to happen because it never should be. But the risk in a tail event happening right now is exacerbated because everyone's on the other side of the trade. With the Red Sea, do you think AMKBY could be a good buy again with the drop from earnings? Yeah, I'm gonna pick some of it up. I have a couple price targets on it to buy back in, but there was no way I was gonna turn down a free 30%, right? um, Especially unexpected 30%. So I did sell off a big part of my position, about 75-80% of it. But I'll probably buy back in when it gets cheap enough. I do like them in the long term. For what it's worth, Porsche's killing it. Can't get a new 911 this year because demand is so high. Fair. Have you tried going to a different state to buy one? Usually that kind of shit's regional. You can probably find some in inventory somewhere else if you extend your reach a bit. In response to increased inflation expectations, is now a good time to invest in tips? Could be. Yeah. Okay, enough questions from you. You've gotten your fair share. How much does the exodus from China impact inflation here in America with capex deployments? It could have a significant effect. I mean, it already has, right? We've been seeing Chinese investors flee from their local markets now for a few months. I would say, if anything, that's starting to wane. And their inflows back into China are looking a little bit better now. So I mean, the PBOC has definitely taken some steps to try to support their market. Whether those steps are going to be successful or not, uh, that's still a big question. But I don't want a Porsche. Gross. I drive like I trade. You shouldn't have a license. But I have so many questions. I know you do. I can tell. Oil continuing its charge up. Any stopping it? I mean, inventories are pretty strong, but I don't think we're going to see any reduction in cuts out of BRICS. Um, there's still the threat of Venezuela invading Guyana. That's going to keep some risk premium just stapled on there, as is the conflict in the Red Sea. So, I mean, I would say oil is probably stable to up, but inventories are good, and the U.S. is producing a shitload of oil. So that may have some stabilizing effect. So we might just get locked here, but it is inflationary right now. And that's not going to affect the US's inflation as much, but it's definitely going to affect inflation in other countries, especially ones that are larger importers of oil, like Japan, where they don't really have a lot of oil production. That's going to hit them really hard. I think SMCI bounces after the drop on Friday. I'll cover SMCI in a minute. It may not. That's what happens when you have a big short squeeze. It's propped up by a lot of weeklies, and they all start selling off. I really shouldn't, but they give out driver's license and gun license to anyone in Texas. So yippee. The BOJ's been dancing around April and March. I think mostly leaning towards April. They're definitely working right now to stabilize yen at USD JPY at like 150. Um, China is also working to stabilize the yuan. We've seen big central bank inflows into U.S. Treasuries over the last couple of weeks. That's probably going to persist as long as the dollar remains really strong, right? I mean, they have to support and or hedge their currency against the dollar, right? Which kind of is funny because it gets rid of the whole de-dollarization idea because China is buying back into U.S. Treasuries at a rapid rate after having shed a significant number of them into the peak of their economy, and so that renewed reliance on the dollar kind of starts to put China back under our thumb. And definitely kills any ideas of de-dollarization in the near future. Thoughts on shorting SMCI next week? I don't want to touch it. The options are overpriced. I'm short like a couple shares, which is fun, but at least I can get rid of them in after hours. Can't do that with options. Yep, March. The BTFP facility is going to be ending, and that's just a discount window that provides liquidity to the banks. The difference there will be, and this is where the impact from it closing comes in, is that the collateral used in that facility they are, is given par value. So all those underwater shit treasuries are treated like their full value, right? And when the BTFP ends, those banks are going to have to turn to the discount window where the liquidity provided will not be a par value, right? So when they collateralize those assets, they'll be worth their market value, which is garbage. The options are also illiquid. Yep. Do you think China's going to be successful in re-stimulating their economy? Kind of, yeah. I think they could print their way into it if they need to. It's not going to be. It's going to be tough for them long term, but I mean, they've gotten big enough that they should be fairly stable, provided nothing bad happens, like the yuan collapses. Yeah, the inflation risks are definitely still there. I mean, really, what it is commodities, right? Commodities are dirt cheap right now, which has lowered producer costs significantly. And since China's demand is low and their economy is weak, commodity costs have stayed very low. I mean, at historic lows. Um, if that demand picks back up from China, there's going to be a more competitive commodities market, which is going to drive prices up, and that's going to drive producer prices up. Energy demand probably as well. If you're looking towards like nat gas, coal, and oil. So yeah, yeah. Broadly, I would say that commodities can rise pretty rapidly, and I think where tech fails, at the point where tech fails, we're going to start to see a lot of the money that's in tech right now go into commodities, especially if there's a strong feeling that we're going into a recession. How does China turn around their deflation? That's a good question. They could lower rates, but they haven't. Mostly because they don't want the yuan to lose any value. Really, what China needs is for the dollar to drop. Um, if the dollar drops, then they can lower their rates and they can rekindle some of that inflation and possibly turn around the deflation. Broadly, though, and on an even longer scale, they're still going to run into issues with youth employment. They're still going to run into issues with their birth rate. Um, those things aren't necessarily something that they're going to be able to solve. And so, I mean, and that's something that we've seen in Japan for 30 years, right? And now we're just starting to see it begin to affect larger economies. The aging population and the lower birth rates. That's something, and all of those are persistently deflationary, right? So those are things for future growth that we're going to need to figure out or address. Um, I'm not really sure how. It's definitely something that needs to be tackled from a cultural standpoint. I mean, you can solve some of it with immigration, but not a lot. And then citizens in most countries are generally pretty opposed to widespread immigration as well. So you've got to kind of battle through that, especially in democratic countries, right? What specific commodities catch your eye the most? I'm long copper. I'm long uranium. I'm long coal. Um, I'm long oil and nat gas. I'm particularly interested in energy commodities. I don't think China's economy turns back on without deploying a significant amount of capital towards energy costs. Um, After that, I think copper is going to see a lot of demand. There's there's rare earth metals that could see spikes far in excess of anything copper will see, but pinning down which one exactly is kind of difficult, and so you got to get kind of exposure all over the place. And I don't really think in the end it'll be worth it. Whereas I know commodity will, like copper, will be a high demand commodity. It's used in everything, and with not only with infrastructure being built out here in the US, but with the demand for electric cars rising across the world, all of that infrastructure um, for electric vehicles and the electric vehicles themselves demand huge amounts of copper. Um, so that's kind of I'm focused on. And in the U.S., we're building out power lines, we're building out telecom, and a lot of the like infrastructure act is going towards that. And so like wire producers or um, copper producers, I think are a pretty strong bet over the next 5-10 years. Is it too late to get in on SRF? I know it's been running a while. I mean, if you can get it below NAV, I don't see the problem with it. I don't see the energy. I don't think the demand for uranium is going anywhere, and I still think we're about 3 to 5 years out from getting any more uranium into the supply chain. Um, Not exactly easy to get a uranium mine up and running. Um, there's a few sources of uranium that you know we can get access to more immediately, but I don't think that they're going to be sufficient to bridge the gap. And so I mean you can't just stop nuclear reactors. They've got to keep going. The demand never ends and the supply isn't increasing. What's the poor way to invest in those commodities via stocks? Yeah, largely. I mean, I have a most if you guys haven't noticed, most of my like longer term pickles picks kind of dance around that exact idea, right? A lot of them are, energy exposed, um, or uranium exposed or copper exposed, right? That's a big chunk of the long term picks that I've had over like the last year, and most of them are doing pretty well. I mean, SROF has outperformed quite a bit. Oxy, BP, uh, ZOM have all done pretty well, and they've been good to sell covered calls on. I think most of them, have a dividend yield roughly equivalent to the average of the 10-year. So you're not really I've been trying not to miss out on treasuries while gaining some exposure, but not direct exposure to those commodities. And I find that utilities are a great place specifically to find a lot of that exposure because they do pay out high dividends. They are fairly stable. They're underpriced because of their debt, and interest rates are high. So yeah, I mean, I've just been buying a lot of those. You missed BTU, Smooth? Completely? Wow. That's been like I've been long on BTU since it was like fucking $13, $18. It's been forever. I feel like I've owned that stock longer than I've been alive. I was a Dillionaire back then. Oh. When IWM do a big old mega dumper. So IWM's in a tricky spot. It's got a massive short position, and then that short position's heavily hedged. And any news that increases the potential for rate hikes or rate cuts is going to see IWM skyrocket. And anything that reduces the potential for rate cuts is going to see it drop. I don't think we're going to get any rate cuts priced in anytime soon. We seem to be pricing in about, well, Fed fund futures are pricing in about 78, 79 BPS of cuts over the next year. So that's pretty bad for small caps in the short term. However, I do think if we do get a credit event or something like that, small caps are going to massively outperform. Um, Overall, they generally have better cash flows and cash reserves as a percentage than you see in things like tech that are very reliant on debt as a form of capitalization. Yeah, actually, you know what I can do the audio on Discord today because it's just me. So give me 1 second. Yeah, no one's joining in today, so I'll throw that up for you guys. It should be live. All right, so I guess let's start digging into these. GME just got past its ETF FTD period. You can see that we got a little bit of covering here. It wasn't too much. And price improvement was pretty minimal. I think even at our peak, we only saw, and you wouldn't have had a lot of time to time this, but I think we saw about a 13% gain, trough to peak over the ETF FTD period. Not terrible, but not particularly great either. Um, usually I just use ETF FTD periods to kind of reposition cover calls and stuff, and that's kind of what I did here. As far as continued covering following that, well, Friday was a little bit weird. So was Thursday. Markets running definitely put a little bit of pressure. Thursday specifically put a lot of pressure on small and mid caps. So we did see a little bit of covering Thursday, but nothing out of XRT. mostly affected IJH and the underlying. So I would say that, if indexes aren't continuously trending up, we're probably going to see more shorting come in on GME. And usually this is around the period where we start to see a larger short. And this is usually also around the time where we see XRT move onto Reg Show. So those are two things we'll be keeping an eye open for. But right now, I mean, if we were to see a covering event for OPEX, I don't think it'd be very large. Yemen Houthis, they lie a lot, but Yemen Houthis say they attacked 2 U.S. ships in Gulf of Aden. Somehow I doubt it would be. Somehow I doubt it was successful. Successful attack, or they just flying drones at ships isn't really an attack unless you hit them, right? Oh, okay. I guess we'll find out. What copper stocks? Yeah, I don't like ETFs. I can't say this enough. I'm going to be very clear with you guys. I don't like ETFs ever. I generally try to avoid them as much as possible. Very rarely do I want exposure to an entire sector. I would much rather do the legwork and find out where the value in that sector is and buy that than get exposure broadly to a bunch of things that aren't going to do so well and a couple things that do well. Not to mention, I mean, with everything that we've learned about ETFs over the last 3 years, I don't think anybody should really be considering putting their money in them. You are almost always guaranteed to lose over time compared to just buying even if you just bought the basket yourself, you would be losing over time. Passive investing is dying. Yep, it is. I've been waiting for forever, but it is dying. There's a very good paper on it, actually. I literally have my life savings in XRT. No, you don't. I gotta pull it up. It's somewhere in my PDFs. But yeah, if I find it, I'll post it in the announcements channel or something. All right, so that's it for GME. Doesn't look very exciting. We do have OPEX. If you're planning on selling cover calls, you should probably wait till the settlement period's over. If the settlement period ends with no significant price improvement in the underlying, you're probably pretty good till earnings to not see any kind of significant price increases. Upstart, absolutely fucking hammered after earnings. Credit conditions are tightening. More importantly, intra-bank credit conditions are tightening. Banks are not picking up loans. So if Upstart is lending money and no one is buying those loans off of them, those are going on to their balance sheet while they hold them until they find a buyer. This tends to be very, very bad for their balance sheet, and obviously in conjunction with that, their stock price. We saw a pretty significant amount of actual selling with this drop, which opens up liquidity on Upstart. We're probably going to see more selling. I don't think confidence is very high here over the next couple of quarters, especially with those Fed rate increases or Fed rate cuts being trimmed back, and even the potential for a rate increase possibly moving into the picture, especially if we get hot CPI next month as well. I'm short this right now. I'll probably stay short for another like 30-45 days, but the sell-off from earnings should provide more than sufficient liquidity for them to drive this back down to these, like 23 $20 level. Then we might have like a little bit of a liquidity event. But I would say probably still a couple months out. We're not very far out from our last one, right? So, yeah, I would expect this to trend down over time. Remember though that any significant shift in the Fed's projected path could see this turn right back around. So keep that in mind. Fubo, a lot of bad news with the Disney shit. I think we talked about this at some length last week or the week before. So I'm not gonna dive into what I think is gonna happen with Disney and all of that. I'm just gonna focus on earnings coming up. They've been beating their metrics. Um, they're well on their path to a positive EBIT by end of 2025. And they've been very consistent quarter after quarter. I expect them to continue that. I'm sure at some point during that period they'll fail a little bit, and that might present a really good buy-in opportunity, as the drop below $2 obviously did. We saw that got eaten right up. And most of the people that sold on the drop probably already bought back in at this point. But it is very liquid right now. It can be shorted more. It may be shorted in advance of those earnings, though we may see some covering after those earnings. Um, but I think their path towards profitability is still really good. I wouldn't make any broad assumptions about Fubo though. It is very liquid and very volatile. So I wouldn't make statements like $3 is a floor now. I know a lot of people thought that after a couple weeks of trading above $3. That's absolutely not true. It's still a meme stock. It still has volatility shorts. Shorts are just kind of getting scared out over these 3 quarters of positive earnings, right? That less tenuous grasp on the underlying. I think the point at which we saw the largest short was right here. Um, and even that saw almost immediate covering after earnings, right? So I wouldn't make any assumptions about what its price can do, but if you do get discounts on it, below $2, below $1.50, those tend to be pretty good prices. And usually you can make that money back in covered calls or CSPs really quickly. Um, I know my cost basis is very negative at this point. Most of its spikes you can pretty confidently sell covered, like in the money covered calls, ideally at the money, but in the money covered calls against, and at $1.50 a share it doesn't take long to trim off that cost basis. Tupperware. Okay, so Tupperware had some interesting stuff come out this week. They filed an 8K, which was a forbearance agreement. So that doesn't mean they're going bankrupt. I know a lot of people thought that. They probably are at some point going bankrupt, but they're not going bankrupt right now. What the forbearance really does is allows them to continue to use their credit facility, but it reduces their total monthly payment. So they're trying to free up some liquidity. We know that they're definitely seeking some loans in order to turn the business around. But I think it's a good sign that they're fighting not only to keep the business listed, but to keep the business liquid. We still got about 2 more weeks before we probably see any kind of earnings report or financial statements out of them. But if those are positive, or at least not very negative, and in addition to that, they're able to um, get some loans and proceed with some kind of turnaround or shift in their business model, then obviously the stock would be wildly undervalued at that point and it could see a lot of appreciation. At the same time, they could release those statements, they could be bankrupt, lose everything, right? So I wouldn't get a ton of exposure to this, but the risk reward on the coin flip could be very good. um I know their annual revenues are around 2 billion. going back to 2017. Only since really 2019 did they start to drop off. And in 2022 they had 1.3 billion in revenues, right? And this is on a company with a market cap of 66.17 billion. And I went to Target the other day and I was like, oh, I should go look at the Tupperware shit. And it's there. It's, got its own display, and they obviously have somebody who's keeping that stocked. But not only were other people buying it, but it was far nicer than the other products that were available in that same category, except maybe besides like Pyrex. But they also had some like glassware kind of stuff. I would say that they're probably, based on their pricing, considered like a premium brand to like the Glad shit or any of that. And they have a lot more uh they have a lot more options and container sizes. This is so fucking uninteresting, I know, but I mean, I stood there for like 2 minutes, like looking at their products, and three people bought their products while I was standing there. And I know it's a New York City Target and it's busy as fuck, but that was kind of interesting, right? I don't want a Tupperware sponsorship. Yeah, Pyrex is not the same as it was in the old days. But I mean, a lot of people still prefer glass because it doesn't have the microplastics. You don't have the BPA's. I was just curious. Like, I was like, what the fuck is so special about Tupperware, right? Like, I know people's grandmas and shit used to sell it, but I think that branding has some value, right? Like, everybody for 50 years, the last 50 years in America is when like, oh, like Tupperware is like, that's the good shit, right? That's what, and people still think that. Who was loss prevention checking on you? Maybe. Although I'm not sure New York City Targets have loss prevention. They just lock everything in cages. Anyway, so yeah, again, Tupperware is definitely a coin flip, but if they are able to turn it around and they are able to get some funding, they definitely generate sufficient revenues to keep a company afloat. Even if that requires some trimming of overhead or maybe reducing their enormous product line. However they go about it, there's an opportunity for them to to turn that around, I think. And especially given their revenues, even with their debt. All right. Beyond, back on Reg Show and getting a little sensitive. We just saw a pretty decent amount of covering through the ETF FTD period. It did just get back on Reg Show. So we saw about peak to trough price improvement was about 25%. Now that it's back on Reg Show, ETF FTDs are off the table. I would expect to see another round of shorting. Now, I don't know if this shorting is going to quite get back to that kind of point where the Vana on the dealer flips. Um, but I would say that it could at least get back to trend or maybe back to like the 650 level. That's where I'm going to be looking to pick up some exposure. The next test of that. Now that it's back on Reg Show, we'll probably start to see FTDs begin to compound at a greater rate because there's less available liquidity. And ideally, after 13 days or so, that'll start leading to more and more forced covering. And then once that forced covering leads to a breakout of gamma neutral, it can do its usual run up. So yeah, I'm gonna be looking between 6 and 650 over the next couple of weeks for entry opportunities on that. But exciting that it's back on Reg Show, at least. Okay, I think that's it for the memes that I'm gonna cover. I guess we could jump into some of the Mag 7, although I'm sure the only one anyone cares about is Nvidia. Agree, Tupperware is a far greater product. I have Tup for my grandma. It like never breaks. Okay, first of all, that shit has BPAs in it. Get rid of your grandma's Tupperware. Don't keep that. Don't eat out of it. Um, but if you want to get some new Tupperware, go ahead. What's the best book on getting a valuation on a stack? Uh The Intelligent Investor and Securities Analysis. I would probably learn Graham's valuation methodologies first, and then you can modernize your approach afterwards. But learn the basics. Understand, learn how a business works, and understand that aspect before you get lost in the world of DCFs and things like that. I'll lay them out of my spread with my Cutco knives. Listen, Cutco knives has made more money in their lives in their lifetime than you probably ever will. Okay, just because something's shit doesn't mean people won't buy it. Don't forget that the pet rock was a product. So is AI. Uh, how much time are you looking to get on Beyond? I want like 45 to 60 days of theta. I'm here. No one replied in the cord, but I made it. Okay. Welcome aboard, Cookies and Leche. No problem, Jen. All right, so Apple. Apple's been kind of plagued with fairly negative options interest over the last few weeks. Its gamma has held positive, so short dated call interest has been persistent despite the constant drop off in longer dated positions. This actually went into the end of last week as one of the few Mag 7 stocks with negative charm. Um, Call interest has slowly waned, but it's staying persistently positive. Dealer Delta, however, is negative, and some of it just dropped off with the Feb OPEX expiration. Most of the options interest on Apple is currently sitting out at the March OPEX. Um, Put selling on it's been pretty persistent at the same levels, but I wouldn't say that it's grown or decreased substantially. Um, Dealer adjusted delta is still negative. However, it is still above DN and GN. Those are slowly dropping over time. So, um, at least from a technical and options based perspective, I would say that the range to the downside on Apple between 75 and 81 is pretty wide open. But the drift down to those levels could be very slow. I just don't think anything stimulated any bullish interest in it, but it's still Apple, so people don't want to actively sell it. So I think it'll be resilient and down um, over time. That could mean that there's still you know uh, call selling opportunities on it, but I'd be careful with short strangles. Um, and that's kind of been my opinion of Apple for the last couple months. It hasn't really changed. Um, I've sold some 30-day call positions on it, and now all of those have fallen out of the money over time, and that's probably going to continue. I would be careful selling calls too close to the money though, as that does still present some risk. So you probably want to look at deltas at like 0.2, 0.1, far enough out of the money that you have time to pull them back should any good news come in. But yeah, that's kind of been the story with Apple for a couple months now, and I understand it's not particularly interesting. But the yields aren't terrible. So Amazon, why is everything on the fucking 15-minute? So there's been some selling from Bezos here, which has really kept um, a lot of bullish interest from picking up. But I do think where it's at right now, despite the technicals, is still pretty stable. Charm's been positive and flat. Call interest is slightly elevated over the last 2 weeks. Dealer adjusted delta, well, dealer delta dropped off pretty hard on Friday, so a decent amount of the call interest fell off here. About a little over $5.5 billion worth. And gamma declined as well. If we start to see a contraction in total interest, that may open up some more downside. The technicals would indicate that this, consolidated, broke out, and then failed. A return back to like the 160-ish level is probably pretty high probability. I would say like down here. But it could take quite a bit of time for that to happen. So it might be like a good target for a debit spread or something with a decent amount of theta, and just kind of watch to see if the interest continues to drop off. I made it in time. Oh wait, Dork, you can join me for the here. Oh, yep. There goes the.
So I put it in my butt, and
I think I just killed the live audio. Yep. Sorry, live audio people.
You there?
Hold on. I'm gonna be with you in a second.
All right.
All right, there we go. I'm just going through the. You could follow along if you want to pull up the data on the Mag 7. But I'm just kind of going through. I'm on Amazon right now, about to do AMD.
Oh, I see. What's the flavor of the week for the pours?
What do you mean?
Like, are they asking when down or? Yeah.
No. There was some interest in macroeconomic conditions earlier, and then a little bit of talking points done on the meme stuff. I was kind of I'm kind of
What are your thoughts
excited
on
about
Nvidia earnings? You think they're going to do good?
who.
Nvidia.
I mean, I don't know. Nvidia's like projections accelerate so much it's hard to believe that they'll beat them, but then they have. I don't I don't know if this is going to be the one that breaks it or not. I would say that the capital spend is definitely there for them to meet analyst expectations. So my assumption would be that they'll beat, or at least come very close to the analyst expectations. And then I don't know if that really adds any value though, unless they project higher. I'm not sure they're going to project higher again, although maybe they will. God, that's so greedy. um, yeah, I mean, I guess it really just. I would say it probably their guidance probably matters more than their actual earnings. I mean,
Yeah.
how many? There's still a cyclical chip manufacturer, right? And we've got to be getting near the point where everybody who's going to be ordering H100 chips has ordered H100 chips, right? Um, And so once that demand drops off, that's it, right? Like there's not going to be it's not going to upcycle again. It's not like they're going to be able to sell them a fucking new product 6 months later as an upgrade, right? This isn't a graphics card, like so. Yeah, I mean, we've got to be getting close to that point, but I'm not sure if this quarter is going to be it.
Yeah, that's kind of where my head's at. I mean, like they not only the capital spend on their chips, but the capital spend by them on their chips, you know, in the form of investing in these other companies. Like it's got a decent amount of momentum. What would be interesting to me is I'm still waiting for them to do some sort of dilution. I feel like that would actually make me more bullish on them if they managed to drum up a cash moat from this crazy valuation they've got. I would do that if I was them, just because having the cash is amazing. You want to take advantage of it fully. That's how you're going to do it, and that'll prevent you from getting any long-term debt accrual if things do slow down.
I mean, Jensen's going to sell before he issues stock, right?
I guess so. I mean, if he didn't, and then they diluted, I'd be like, all right, that's super bullish.
Yeah.
But yeah, I mean, it all depends on what this is, right? And that's the thing is, I feel like there's a ton of you know like apparent investor confidence, I guess you could call it, where like it feels like everyone's super confident in Nvidia, but like given their valuation and given where things are progressing in AI, like I feel like that's going to start waning over the next year or two unless some major breakthroughs happen in other fields other than generating pictures, you know?
Yeah, someone would mention they were super bullish on the video generation stuff that's been kind of popping up lately. Is the next hype train for AI, right? And I don't know if you've seen it, but basically you can put in a prompt and generate like a short form video, right? And
Yeah, I've seen some of those.
it's pretty good, but my argument is that everybody who's ever copywritten a video is going to be scrubbing every single piece of AI content for copyright violations, and those models are trained on copywritten material, right? And they're going to get the fucking shit suit out of them. um
Yeah,
there's iteration logs, so it's not, I don't think it'd be hard for a team of patent lawyers to come in there and shut down you know just a shitload of content in one fell swoop. And then you're gonna have to, because at some point all of these AI companies are gonna have to deal with that legal speed bump, right? And I really don't see copyright law changing to their benefit.
yeah,
Which means that a lot, like, and then what are we gonna get? We're gonna get LLMs trained on like NPR and PBS shows, and like those just aren't gonna be as robust.
well, yeah, and
um,
and like it's whenever I see these AI videos and stuff, I just remember Jay Fresh's little post that made me laugh so hard when he was talking about video game controllers and he was telling it to make video game controllers. And like the one time he put all the random objects on it, and his son walked up and asked, "Is that Pepsi ketchup?" Yes, yes, it is. I just whenever that's the only words that pop in my head when I see these videos is that's probably Pepsi ketchup.
yep.
So that's why I think that a major breakthrough somewhere else would be cool. I'd be super down, but where things are going right now, it's like you could tell it's just a bunch of executives telling a bunch of nerds what the world needs right now, and apparently what the world needs is ways to make videos and silly pictures of cats.
Yep. Well, people now the cat argument, has been used in the past, and people said the same thing about the internet. But yeah, I kind of agree. I don't think there's a path forward for that without some significant legal challenges. And I don't think legislatively we're in a position to deal with that. Like I don't see it working out in AI's favor.
Right, right. Yeah, like there's so many cool uses for it in like medical technology particularly is where I see it being used.
I mean,
Like,
that's more like deep learning and machine learning, though, right? That's not really generative AI.
right, but you can use the same chips to do like, crazy amounts of compute. That's really more so I think the power of the chips is just their raw power and their ability to just take a shit ton of numbers and turn them into a big giant line. That's really cool, but uh the thing is that's going to come from like medical academia or just academia at large,
Yeah.
which is a pretty slow moving beast. And I wish Jfresh was here to comment on that, but
They're kind
I'm
of
sure
also
he.
academia is also kind of priced out of the H100s. So until that market cools, you're not going to see a lot of universities picking up H100 chips at $90,000 a pop.
Right, or they get government grants. I mean, that's more what I see giving universities access to those is getting grants to either use, offsite AI or to build their own sort of data centers, but more likely to use other people's.
Yeah, probably just offsite cloud compute, like using that compute time.
Yeah, which would make more sense. It'd be more cost efficient unless you're like somewhere like Stanford. Then they have so much, like an ungodly amount of money. They probably already have a few H100s.
All right, so let me wrap up the Mag 7, and then me and you can
Yeah,
hop in
yeah,
on
yeah, yeah, yeah.
some cooler stuff.
Yeah, for sure.
So AMD, I know it's not really part of the Mag 7, but its valuations skyrocketed recently, so we're gonna take a peek at it. Big drop in call interest last Friday. A pretty decent amount of charm falling off of the chain. Charm almost back to neutral now on it. So not a lot of weekly interest on it this coming week. Gamma still remains slightly positive, and then dealer adjusted deltas almost fallen to zero, and Friday saw about 3 billion in total delta fall off of the chain. We are seeing gamma neutral move a little bit closer to spot, but delta neutral is kind of staying pretty fixed around 146. I would say that the current downside probably has a bit of continuation left in it, maybe back to that trend line that I've marked there. Um, and that's probably around what, like 166. If it were to fail 166, yeah, that's about 166. If it fails that 166 level, then it can start becoming significantly more bearish. So there might be a play here for some short dated puts to take advantage of that's like 73 to 66 drop. I know it's not a huge range, but on weeklies you can make some decent money off of it. And then if it breaks down below 76 or 66, 166, then it has the potential to get far more bearish. It starts to move towards gamma neutral and then delta neutral.
Did I hear you say AMD's charm is negative, or is it just like reducing?
Which it's like flat. It's
Okay.
yeah. After the expiration, I think it went from like 70 to 6.
Okay, so there's like a
So
little bit of
yeah,
upside pressure.
there's just
Like,
very few like weeklies for this coming week, right? But yeah, a tiny bit of positive pressure on charm. But I would say that enough of it fell off that we could kind of move down below that 166 level.
okay.
But
Yeah, that makes.
also a big drop in bot calls, right? Because there was a lot of weeklies on it for OPEX.
So yeah, I guess the next step would be to keep an eye on gamma neutral and see if gamma falls negative or just falls off, because
Yeah.
that's going to be primarily what props up any sort of a sell off.
Well, I think like dealer adjusted delta hits negative first, then maybe charm alongside that. We are seeing an uptick in put interest, and that's been growing since like the beginning of Feb. And I think most of that's out in March. So if put interest starts to slide a little higher, then our call delta, we're probably that's probably the point at which we see the most downside. But yeah, I'm looking at dealer delta and then gamma over the next probably week. to see where that goes, because both of those are pretty close to shifting negative.
Okay. Okay. Yeah, that's it. I mean, the market is definitely reaching some sort of a I wouldn't necessarily call it a top. I mean, you could argue it is because of the yield move, but I mean, if anything, it's everyone's kind of just taking a step back and sort of. I think they are. People are just wanting to hedge downside on their stocks because of the moving yields and the fact that inflation, is seeming to be picking back up again. We've had a few data points now that point towards it bottoming, but
Yep.
I think it's too early to say people are going to start, de-risking from these sorts of stocks, especially the Mag 7. They're just so freaking huge and so well
Well,
capitalized.
we say that, but then we come to Google, which actually looks bearish as fuck.
Oh shit, yeah,
So
it does.
so Google ended the week negative, just a little negative on the charm side. The more important thing I think that we see here is that short puts on Google are pulling back really rapidly. Over the last, well, since like the beginning of January, really, we've seen a pretty consistent pullback in short puts on Google. There's a They kind of got reinvigorated around the beginning of this month when I first went long Google. That's died. Dealer adjusted deltas falling negative. Gamma's very close to negative. Call interest has been falling off, but long put interest isn't really picking up. It does look like it's going to move towards a test of gamma neutral this week, which is around 138.36. If it falls below gamma neutral, obviously that's going to open up some short dated downside, and then we'd be looking towards delta neutral, which is around 130 for a continuation to the downside. So Google actually looks pretty bearish. The interest, not only is total interest waning, but it seems that directionally the bullish side of it is fading. There's not a lot of bears yet, and so there may be more advantage to taking like a vertical on this, like a credit vertical, like a call credit spread, than there is to buying a put. But getting a put with some theta and seeing if this continues to play out may not be the worst idea.
Yeah, it looks like we're kind of reaching the bottom of some sort of, resistances, I guess. We're right at resistance. Um, what are so I didn't hear the Greeks on Google, but what's dealer gamma looking like down here?
Dealer gamma is around negative. Well, adjusted is around negative 7 point or negative 1.3 billion, and then total delta is negative 7.5 billion.
Ooh, yeah. I mean, it sounds like some people's puts have printed. Um, I mean, yeah, a put. I don't think I don't think it's terrible, but sounds like volatility on Google's pretty high.
Starting to
Um,
pick up. So a lot of Vega exposure fell off at the end of the week. Um, it dropped about 4 million in Vega exposure. Charm's negative, and then it dropped a ton of bot call interest. So I think the bullish positions were largely positioned for Feb OPEX, and I think those mostly fell off. Like bot call deltas almost back to negative. It's at like point 0.1, so it's really shitty. Um, so yeah, I think we could continue to see more downside on it, but it may slow as we approach gamma neutral. That's why I'm thinking maybe like not a put yet, but like sell calls, because it's probably not going up, but it might get hung up going down.
yeah, I think it all depends on market confidence in Google. I mean, they've been pretty like everyone's been talking about new shit they're doing. Apple with their whatever, they got their VR goggles they released. You have Meta saying AI a whole bunch and talking about how Apple's goggles suck. Uh, Tesla's just a pile of shit, so we don't even need to mention it. But Google's just kind of sitting there, just being Google. you know.
Yeah, they are. There's some negative sentiment surrounding the like open AI push for AI assisted search. Um, because a lot of people are thinking like Sam Altman's gonna crack Google, and Google's no longer going to be the de facto name in search moving forward. And I will say that AI does, like generative AI in its current forms, does present some risk for Google search, maybe more than anything else. um but yeah, I'm not. I think that might be part of the bearish sentiment. The other part being that they seem to be struggling to really get their feet on the ground, despite having the longest development of AI products. They're really not kicking everyone's ass in that field, and that's, I think investors are pretty pissed about that.
Well, to me, like in terms of like AI companies, like companies that use AI, Google's been doing it of all the Mag 7. Google's probably been doing it the longest. And then
The,
close second is Apple, and then
I think part of the
Amazon.
problem with that though is that their expectations for it are muted, right? Like they're and I feel like that should be telling for the entire industry, is that Google's been actively using AI products for like, and developing them for like 7-8 years now. And they're like, yeah, it'll make like maybe a little money someday, and everyone else is like, this is the future. um so maybe that's a bit of a foreshadowing of
Well,
where
so
AI is headed, from a company that understands it better.
yeah,
But in the
so
short term, they're not generating a lot of hype.
yeah, I don't think they want to. I think they want to stick to what they know. But so Google made I think it's called Keras AI coding language.
uh
But it's actually, I look at AI like Reddit boards and stuff, and the most popular one, the de facto standard now, is becoming PyTorch,
okay.
which is Meta's, like they open sourced their API code,
Hmm.
whereas Keras you have to use like Google's platform to use it. So, that could be part of the sentiment shift too, is that, more diligent investors probably notice this shift away from Google's AI platform. Um, but you're right in that Google does not expect AI to necessarily cause an explosion in revenue, uh, and that's interesting to me. Um, because of the reasons you stated. They're a huge company, they're a juggernaut, they've been using AI forever, and look where it's got them. It's got them this far, right? And maybe
Yeah.
that's why the valuations are starting to level off where they are.
I
uh,
mean, possibly. I think Google's actually a little undervalued, especially compared to the rest of the Mag 7. But I kind of understand the lack of confidence from investors in it right now, which means that if it drops enough, it might get to the point where it's a pretty good value again. Um,
yeah, I kind of like Google under like 130. That's not a terrible price. Under 115 to 100, you bet your ass I'm probably going to be shopping around for some Google.
I'd like to buy
uh,
back in at like 80, but yeah, okay.
Yeah,
um,
80 is nice, but that's it's a little ambitious. I mean,
I got
if
it
they fall
last
back
time.
to 80, there's problems.
Yeah, yeah, fair. But
But
anyway, in the short term, which is, I guess what we really care about, it does look like it's starting to fall off a bit, but it may take some time to continue its decline past like that gamma neutral point at like 130, 138ish, right?
yeah, I think this is going to chop for a little bit.
Yeah.
If I were if I were to guess where it's
Although
at,
if indexes dump, it can just fall. There's nothing holding it up. So I will say
that's
that
true.
much.
Yeah, yeah. If that happens, bearish. If Google just doesn't consolidate here, that's pretty fucking bearish.
All right, Meta. So I was pretty bullish on Meta last week. It had a nice strong surge of interest into the beginning of the week. Some of that materialized several times with repeated tests at like the 480, well, 480 and 485 levels. And I kind of failed into the back half of the week with the decline in indexes. This still seems to be pretty exposed to like Nasdaq moves. It's so far above gamma neutral and delta neutral that I don't even feel like they're worth talking about. But dealer delta has moved negative again. Gamma's dropped off pretty significantly. This had a huge drop off in charm on Friday, almost 200 million, which for an individual stock is a lot. And obviously, bought call delta fell with that OPEX expiration as well. If this drops below 461, 456 in the early part of this week, I think it's got some pretty good range on it. I do kind of want to pull up kind of the OI chart on this and take a look at that. Give me 1 second. So I wonder about just how far it could fall here. I know there's a lot of positioning around 75, which is kind of where it's sitting right now. And then a lot of those calls to the upside have sold. So I think, yeah, I think gamma. So if it crosses 70, it's pretty smooth sailing down to like 60, 50, which is a lot of range. Ton of range. But 70's kind of the last supportive level here for Meta. 75 does not have strong call interest, so I'm not really worried about it moving back to the upside test. And so yeah, 70's kind of the last line of support, and then it's pretty flat all the way down to 50, which is about a 1 sigma move. It's about 4%, a little more than 4%.
That's reasonable.
Yeah. So, but looks like pretty open room all the way back down to the bottom of this. Fucking, I don't know where I drew that trend, but it's no longer relevant.
That jump is so crazy.
Huh?
That jump is just so crazy.
Oh, with earnings, yeah.
Yeah.
So I'll probably do a write up on Meta tonight for this move. But it looks pretty good, and vol isn't very high. So we know we've got a lot of call sellers coming in. Vol's crushed out pretty hard over the last week. So probably some decent push to break down through this. Watch for support at the trend, obviously, but yeah, if it loses 70, it can free fall about $20. Microsoft, I don't like using options to analyze this very much. But we can take a look at it. All right, so yeah, Microsoft just never has like the options interest everyone else does. Everything's pretty flat here. I probably just wouldn't fuck with it in any way. Um, dealer delta is still like adjusted delta is still positive. Gamma's positive. Put selling is pretty constant. It's maintaining about, actually over the last few months it's just pretty constantly maintained about 128 million in Vega exposure. Charm is flat, was I guess slightly positive after the expiration, and call interest is also pretty flat. So probably more flat. I don't know how broad the chop's gonna be, but it was pretty broad last week where everything was also pretty flat. It did have that like 1 day of a decent breakout, kind of fell after the dividend distribution. So maybe it finds some support here and like fills this upside gap area back around like 410, 415. But I would say it doesn't look like it has a lot of support from the options chain, but the options chain's also not pressuring it down. So yeah.
This feels like to me like the Mag 7 is entering like a just a an aggregate point of consolidation. Would you say that's a fair assessment?
I think it's all just consolidating into Nvidia's earnings.
I think you're 100% right.
Yeah.
Yeah,
I don't think
that's gonna
anybody's
be
making any moves on greater valuations for the Mag 7 unless Nvidia continues to show improvements. Right? They're selling the shovels. So if Nvidia is not doing well, then the rest of it's all bullshit, right?
right, right. Well, I mean, yeah, the shovel sellers generally like the shovel sellers do the best overall in every metric in these sorts of rushes.
Yeah.
So, I mean, you're really kind of getting a not necessarily a lagging indicator, but like a very what's the word? Very I don't know. The distribution of earnings is going to be really smooth and big, right? Versus say like your Metas and your I guess your Microsoft. Although Microsoft also makes hardware too, and Google makes hardware as well. So, but that's they're also fucking slow moving. Meta's about the fastest moving company in terms of their earnings, right?
Yeah.
So it's a little more worthwhile to pay attention to them. But Nvidia continuing to do well, yeah, is going to keep pushing.
There's also another effect that we're seeing, which is the cyclical nature of their revenue growth is that, you know, last year when revenues were bottomed out and everything looked like shit and they were showing performance improvements even though they were significantly less than prior revenues the companies had experienced, their rate of growth was so exceptional compared to the rest of the S&P that they became the primary focus, right? But that exponential leap in growth has topped out, right? It's no longer parabolic. In some cases it's dropping, right? We saw that revenue growth and now it's kind of getting to this point right here, and people are a lot less bullish on revenues going like this for any period of time, and they're very much less bullish on revenues going like that. So I just don't think we're going to see that kind of explosive growth anywhere but like Meta, Nvidia for now.
Yeah, isn't it crazy that the Mag Sevens total revenues account for 6% of nominal GDP?
I mentioned this to people earlier. If you take the Mag 7 out of the S&P, it's trading at a forward PE of 18.1 and it's down 10%.
Damn, quit shilling RSP to me, you goddamn shill. Uh, Honestly, RSP seems like if you're like a super diversified investor, RSP right now seems more attractive than S&P 500. You like being 30% exposed to 7 companies, like with a share of VU is just God. You got to feel like an asshole buying that right now.
Well, it's all about VTI now. You got to catch up with value investors. Our value investors.
Oh, right. They want the whole entire shebang, right? Yeah, they want such diversified growth
I love
that it's
going in there and them
incredible.
reading about how like if Nvidia drops to 300, they're gonna hodl. They're gonna hodl for 10 years no matter what.
Oh, that's what value investing is. It's just literally hodling until you're about ready to die, and then you sell it like
They're all
little
just
bits.
liars. They're just liars, Dork. They're all gonna fucking panic sell the second it drops 20%. Uh
uh,
Cobra, welcome back to Pigeon Whale. I think you meant to sign up for Cornishon, but or you got a new credit card. And if you did get a new credit card, congratulations, G Square. Thank you so much, man. I'll play you guys songs later. I can't do it with Dork on the line because I'll blow your eardrums out.
Oh yeah, but
SMCI is a steal of this. Shut the fuck up, popcorn trader.
can we talk about Carvana?
We can, but not yet. I have to
Okay.
finish Netflix, Nvidia, and Tesla.
Oh yeah, that's right, Netflix.
So Netflix, interestingly enough, looked like shit at the beginning of last week, or 2 weeks ago, and then it picked up a bunch of call interest, which rocketed it up over 2 days. And then now that call interest has largely fallen off. Gamma dropped by about 300 million. Charm Charm moved back to, well, pretty flat. And then this one's just been such a pain. It's so volatile and illiquid at these prices. But yeah, it bounced right off of fucking gamma neutral and it went up from the 13th to the 15th. It went up 8%. It's almost $50. It's pulled back a bunch of that on Friday. It's back down 3% from there. Netflix is just like this. It's pretty illiquid for a mega cap. And yeah, so its price action can be pretty volatile. Although it does look like the breakout failed. I would be probably looking to like the 575 level for a continuation in the breakdown. There's a lot of sold calls that are in the money on the chain right now. 575, 570, 565, especially. So if it falls back below those, it'll probably re-accelerate back into a test of GN, which is currently at 548. But I know some of you guys are sitting with me on some 550 puts for March here. I still feel fine on those. I sold last week. I sold some 60s against it, and then I ended up closing those and selling some 70s against it, and then I closed those Thursday night. I don't think I'm going to sell any this week because it does look like positioning broke down a little bit, but if it starts to find some support around 580 again, I'm gonna sell another weekly credit spread against those 550 puts for the time being. Just keep harvesting. I mean, when you're short like that and you have some theta, it's really good to just keep harvesting those premiums, and use that put as kind of your hedge on the credit spread.
Yeah, just harvesting theta to offset your depreciation.
Yep, pretty much.
Smart.
Nvidia, I mean, Nvidia is just going to be all about earnings, right? It's hung up here. It's been hung up for a little while now, between this like 700, 725 range, almost 2 weeks. I guess 675 to 750, about 2 weeks. Um, Adjusted delta has been falling off pretty hard. Gamma fell off pretty hard over the last few days. There's been more and more and more sold calls at the 750 level. Gamma max is at 766. Pretty decent amount of charm. Almost half a billion in charm fell off over the last 3 days, and call interest. So this may correct back towards like the 725, 700 level going into earnings. And I think playing something going into earnings on it might be a better play than trying to play earnings. Although I know that a big move is priced in for this week. I think it's, give me 1 second. And it, and just to note, this will probably increase as we get closer to those earnings as well. But holy fuck, this takes so long to load.
Well, their options chain.
Yeah.
Let's see. So the Feb weekly.
So it looks like, yeah, it looks like they're pricing in about 8.7% for this week. That'll probably be about 10% by Wednesday. So the advantage you have in going long or short or straddling here, is that you'll benefit from increases in implied volatility as we approach earnings, as long as you plan to cut that position before earnings. Um, then you can definitely take advantage of the increase in IV. I mean, just for tomorrow, there's almost a 4% move priced in. So like the lower bound is like 701 and the upper's like 758, which is insane. I've been straddling this for about a week now to kind of test out the viability of it, and the returns are far better than they are on the S&P. But part of that because it's chopping in such a wide range. I'm sure after earnings it will become more directional one way or the other. Um, but yeah, there could be like a short play here as things kind of consolidate into earnings. So the next 2 days, and then earnings, you would obviously have to take some sort of different approach. Maybe like a God, I hate inverse condors so much.
I was about to say an inverse condor.
I mean, yeah. Let me see what the payout looks like on that.
Yeah, I mean, the premium at the money might just be too high to make it worth. You might have to make it super wide.
Or maybe an inverse butterfly. Actually, inverse butterfly is not so bad. You could do like 25 with the sold legs at 7 for an 8% return. I doubt it trades flat, but you do need like a 4% move either way to hit maximum profitability. And then yeah, you could do like 700, like 675 on the, or and then like 500, 775. That needs about a 7% move, but return on risk is 36%, which is pretty nice. And then that's not affected by IV crash. So what that is an inverse condor is basically two debit spreads on either side. It's kind of like straddling with debit spreads.
Yeah,
I'm not sure the straddle is all that great. Or maybe the straddle is just fine. The straddle's gonna get. Here's the problem though. The straddle definitely doesn't like the the drop and fall, and you need, so an at the money straddle for this Friday needs an 11% move. That's a lot. That's asking for a lot. So yeah, I would say maybe an inverse condor for earnings might be the best. And then if you really want to, and you think it's going to do something crazy like go to 1,000, you could buy like some 950 call, 600 put outside of the condor. And then if it really just fucking takes off or tanks, you can pick up that like fringe distribution case, right?
yeah,
That,
that makes more sense. Yeah,
yeah, that would be
but the
something. That would be something like this. Hold on, I think I can show everyone this.
those contracts are going to be dead the next day though if it doesn't go up or down a
Yes.
bunch.
Well, that's the benefit of doing the condor on the inside. So you do the condor, right? And yeah, this is around 725, and that's like a $1,700 debit. But then what you can do is you can buy like the 800, and then buy like the 650, right? And I don't really know if that's worth it, but I guess it depends on how much IV drops. You know what? I don't even think that's worth it.
You'd honestly want to go further out so that way your loss is capped a little bit better.
They're so
Like I would
fucking
think,
expensive. Yeah, you'd have to buy
yeah,
like even if you buy the 1,000, it's just terrible.
yeah, no, the Vega on this in this fucking stock is just ridiculous, right? Yeah, the 1,000 and then like what, like the 500 or something.
Yeah, that's just fucking garbage. I mean, it's not too bad, right? You still make your 29%, but
Yeah,
you're
roughly.
buying like weeklies at 0.008 delta, 0.02. Jesus Christ. Yeah, fuck that. I think just the inverse condor, the inverse yeah,
Yeah, you're just lighting.
41% return on risk is much better.
Yeah, you're just lighting money on fire with those fucking contracts.
Yeah, that's just, it doesn't work. Anyway, so
That was
yeah,
way better.
that's probably my approach to Nvidia earnings. Maybe even like I would open the put spread at the beginning of the week, and then when it goes in the money, open the call side.
Yeah, I mean, depending on how much money you want to throw at it, like, you could even reduce your risk with a tighter inverse butterfly, but I mean, your return on risk just probably tanks as soon as you tighten it up.
Yeah, yeah, it does. All
Fucking
right, Tesla's the next big one. Tesla's the last one. Tesla had a bit of an interesting recovery last week. The Bulls did get behind it a little bit, and they pushed Gamma back to the positive. They almost pushed Charm back positive, and they almost pushed like adjusted Delta back to positive, but they ultimately failed at doing all of the above successfully. At the end of the week, only Gamma still slightly positive and barely at that. If this falls back below 200, it's going to start to get some negative pressure. And then, delta neutral's down at 190, gamma neutral's below delta neutral. So, not a lot of short dated interest left on the chain after this week. I would say this looks pretty weak, and I don't want to say it's in a good position to short it yet, but I think if it loses, if it stays under 200 Monday and I start to see indexes decline a little, I'll probably go short with that 190 target. And then, set my stop. And if it breaks 190, I might add to that short. I might add to that short around like 187, which has been a very important level for quite some time. So, but yeah, Tesla doesn't look very strong, which is reasonable. I mean, they're still massively overpriced for what they are. So, all right,
What
well,
cutting vehicle prices continuously over the past year is not exactly bullish.
yeah, no shit. Well, not it's not just the vehicle prices, right? It's everything's working against them. Their share of the Chinese market's been collapsing. Um, Material costs have gotten slightly more expensive, so their manufacturing, like their overheads risen. They've got, they're selling vehicles for less money to try to offset the cost of financing, right? But financing costs aren't coming back down, and so it's forcing them to keep vehicle prices low. It's just, I mean, Elon's a fucking nut job, right? There's so many problems. Um, I see it getting probably a lot worse before any of it shows any kind of improvement. Maybe they could get rid of Elon. That would be a huge step in the right direction.
I'd actually
Um,
buy Tesla stock if they did that.
yeah, I mean it'd be cheap as fuck too, right? Like I mean it
Yeah,
would
it'd be super
tank.
cheap and
Yeah,
the dividends would go up though once he's out of there. I mean, think of all the money they give him. All
I
that
know,
just going back to other investors.
I know it'd be awesome. And they've got a window of opportunity there with that fucking judge ruling ruling against his pay package.
I'm pretty sure he actually like the thing was the pay package like conditions. I'm pretty sure Tesla went above and beyond those too, which was really interesting that they just rejected it like that.
Yeah,
But you know,
I mean it was
screw Elon.
egregious. The amount of money they were paying him was stupid. Like
Yeah, sliding
there's no
scale compensation.
defensible case for paying him that much fucking money.
Yeah, sliding scale compensation packages like that for that high of percentages are just insane. Like it's like that is peak gilded era capitalism, if you ask me.
Popcorn wants to know how do I bet against Egypt? They've been resting on having those pyramids for too long. Pending home
That's a
sales
tough
dropped to a record low, even worse than during the financial crisis. Yeah, I posted a chart about that um, a little while back. I don't know if I have it on here. I might. Hold on, let me look at my downloads real quick.
Wait, Gert. Am I part of a 0.1% right now?
Yeah, you're one of the only idiots buying a house right now.
All right. It's all good. I'll be fine.
Yeah, yeah, you will be. But
The,
uh,
the thing about the housing market is, and I feel like we've gone over this, is that it's highly localized. Like the markets that stand to suffer the most are the ones that have received a lot of like cross country moving, right? So we're talking like the Idahos, the Montanas, where tech bros have moved, to work remotely for a giant tech company. And once their giant tech company says you don't get to have this job anymore, now they got to find a Montana job and live on Montana wages.
so this isn't pending home sales. So this is the median sales price for homes in the U.S. year over year. And median home prices are the lowest. This is the steepest drop in median home prices since 1965.
So as much as this could be seen as an improvement for the housing market, like a healthy correction, right? You could pull up that monthly payment chart and show that it's still
Oh
super
yeah.
whack. But if you integrate that curve, right, like housing prices, they have a long ways to correct from their big giant bounce, right? Like at the median.
Yeah, we can pull that up. So yeah, if we look at the average American consumer buying the average priced home, making the average priced amount of money, about 70% of their income goes towards purchase. About 72% of their income goes towards purchasing that home.
Yeah, yeah. No, it's ridiculous.
So
So
wages either have a long way to go to catch up with housing, or housing has a long way to drop to catch up to wages.
yeah, I think a 10% correction in median home prices is definitely warranted. And even so, if the cool thing about that is if that happens, inflation's going to drop really fast.
Dude, these
Because
peasants need to chill out. Yeah, I mean, well, will it? If inflation is not lending based, right? And inflation is supply has to do with supply side economics. Housing prices dropping isn't going to fix the issues in the Red Sea. It's not going to change shipping prices, right? Like we might get a drop in housing and rental costs, and that definitely helps ease CPI. But if CPI is driven 6% higher by goods costs and PCEs, core PCEs driven higher, right, by increases in expenditures, then the housing prices aren't going to matter much.
that's
They're
just that's
already
just
they're already astronomical, right? Like they're ridiculous. But
well, if we see hard asset devaluation like that with consumable goods, valuing higher, we're pretty much just entering stagflation at that point.
I mean, I think if we see hard assets drop, we're just going to see a shitload of defaults.
We may.
I think if any of those people that bought houses at like 3% or 4% mortgages go underwater on their equity, they're gone. Right? That's the only reason they're staying in them is because they're positive equity at a cheap rate. But if that inverts, ooh.
Yeah, I mean, well, it comes down also to the quality of the credit, like revolving credit in the market too. If that takes a big hit, then uh, we're gonna see the assets grouped up in tranches start to get sold off, and that's when these people who may be stuck at a 3% mortgage rate, they may also be on negative equity, and they may not be able to move even if they have like the cash to make up for the negative equity because access to credit is just so shitty, right? Like mortgage rates could spike even higher if the risk on them increases enough that banks want to make sure they're covering that risk, right? And that's partially what we're seeing in the mortgage rates right now. Like people said, financial conditions loosened a bunch, and they did, but the average credit quality of the average American is deteriorating, as seen by the rise in credit card delinquencies. And that's why you see mortgage rates not really falling off as much as they potentially would have had the economy actually been strong and not just leveraged.
Yeah, yeah. I mean, there's also the carry trade to consider there, right? If the carry trade collapses, banks aren't going to be able to lend at these prime rates anymore. And
The
right
rates are really
now,
good for where the 10 year is at. Rates are really good for mortgages and shit.
I got a pre-approval kind of for fun this weekend yesterday. I was out, my buddy's still house hunting, and I wonder what I could get. And I got like 5.78% for 30 years on 1.6 million. And and like that shouldn't be possible. Right?
Well, I mean, now
Why the fuck are lenders giving out loans? I mean, like I have good credit, like okay income, but why are lenders giving out loans at like the federal funds rate? Like it's ridiculous, right? Like those loans should be 8%, 9% right now. They're so desperate to lend to just anybody. The fucking pre-approval took like 30 minutes.
yeah, no, my first pre-approval
They
was
didn't check
crazy.
shit. They didn't check my assets or anything. They just fucking they looked at my credit score and approved it. Like they don't care.
Yeah, yeah, no, and they look at like, whatever your income is, and they're like, all right, multiply it by like, whatever, and then there's the number.
It's called
No,
buying
yeah,
deposits. Yeah, yeah, it definitely is. Like you got twenty
yeah, no,
percent, it's yours.
no, my mortgage broker, she had some egg on her face for waiting for the CPI print. And so so what they're doing now, I noticed, is they're also uh, like the mortgage brokers are starting to, if like rates move a bunch, they're actually just giving you credits to push the rate back down to what it would have been on your pre-approval. So um, they are willing to do a lot to get people into buying houses, especially if you're a low risk borrower, right? Which you would be.
Yeah.
Um,
The house came with the house came with a $75,000 credit. um on top of it. So it was $75,000 at close. I think it was 1.3 million and then another 3 million for like the rehab, or zero point 0.3 million for the rehab. Um so I would have gotten like 1.675 at 5% basically.
fuck.
Yeah.
It's time for you to buy that Reno penthouse, dude. Let's go.
Ew. I want to buy that weird French house that's in downtown that makes no
Do
sense.
it, dude. Do it. That's gonna be
It has
your new
graffiti all over the walls. Stylish graffiti. It's like Banksy lived there, but Reno Banksy.
it's gonna be your new OnlyFans uh what is it called? OnlyFans, not a brothel, film house, like a TikTok house, but OnlyFans.
Yeah, it's esports.
Yeah.
It's an
Oh yeah.
esport. Yeah, it's just a different kind of. It's just a different flavor of sporting event. That's all. um Okay, yeah, so Poopy Pants says, good, can you talk on Japan a bit? If you haven't, seems interesting. Going into recession, yen getting powdered harder than Carl's wife, and yet Nikkei 35-year high. All right, I'll pull up the chart here and you can start talking about this. Someone's at my door, so I'll be right back.
um so the carry trade has been interesting. I mean, from what I look at, we've seen over the past like since the beginning of the year, we've seen flows back into the carry trade, which incidentally coincided with a jump in high yield AAA credit spreads. So perhaps some of this carry trade utilization is going towards providing more competitive financing rates for those lower quality borrowers in the corporate space, but I think that it may also just go towards making sure credit conditions across the market in aggregate don't get too tight to where things start to kind of sputter, right? Um, Mirror the Nikkei without the yen risk, but yen going up adds to downside to it. Wait, so DXJ is the Nikkei, but weighted towards the dollar? That's an interesting way to do it. I could look at it later. I don't know anything about it. But yeah, so in terms of carry trade since the beginning of the year, uh, it's been utilized, kind of dropping off since, end of Jan. Uh, but, with the comparative value of the yen to the dollar, uh, we're pretty much right around like the 2007 through 2008 levels of relative value. Um, Whether or not that does any sort of reversal, to be quite honest, it's probably not going to happen, right? Unless something shitty happens, assets start to fall off, someone does something stupid. Um, so I expect the carry trade and the relative valuation of the yen to the dollar to sort of stay at this suppressed level, unless Japan does some sort of intervention, right, in order to stabilize their currency, especially in the face of their economy, right? Their economy is so fucking weird. And I forget what their last prints were, but they were super fucked up. So their central bank really ought to strengthen their cash reserves. But I think that they understand that doing so would collapse these, spreads between JGBs and treasuries.
Where are we at?
I'm just riffing on the relative valuation of the yen to the dollar and Japan's last economic data prints that were super weird, and how there's pressure on the BOJ to stabilize this nonsense, but they don't want to go and tighten global credit because that'll be a net negative for them as well.
Well, yeah. So there's a lot of factors in play here. You have, I think one of the biggest ones you have is Japan's obviously a huge holder of U.S. Treasuries, and in order to boost the yen, they would probably need to sell a significant portion of of that of that U.S. Treasury of those U.S. Treasury holdings. Um, they don't want to do that. It's political capital, not just liquid capital. Um, and we are allied, and militarily our interests in the area are very important to them, especially in defending like South China Sea and stuff like that. So they don't want to collapse, or they don't want to be the cause of the collapse of our treasury market. At the same time, they are facing a recession. Their currency is spiraling. They can only act as the lender of last resort for so long for the U.S. banking system before their currency ultimately does collapse. Um, and so they're pressured on both sides this way. And the reason the Nikkei is ripping to 35-year highs is because their currency is dropping. So, investors are fleeing to equities. This is really common when currencies start to fail really hard. Is that the market, you know, the equity market will rocket. You saw this in Turkey before they decided to move forward with a positive interest rate. You're seeing it in Japan now on a much bigger scale because Japan's equity market is the second largest in the world. Um, and so yeah, that's what's driving the K higher. Japan has said a few times, I think, now in press conferences that they really don't intend to make any moves, at least regarding positive interest rate policy till April. That was put on hold most recently with the earthquake that came. There was going to be some aid issues and infrastructure costs, and so they obviously wanted to fund those at a lower rate. so before they move to a positive rate. But it does seem to be that, they're pretty intent on hitting that positive rate in April. I know the IMF drew them up some guidelines for that, and their recommended path forward for increasing interest rates, which is extraordinarily slow. Japan may not have the option to go that slowly. Obviously, they have to keep their currency. Um, they have to keep their currency floated, and right now they still have reserves. They still have money to keep doing that, but the more the dollar pressures it, the faster those reserves are going to bleed, right? So that runway isn't it may not last as long as they intend, and the dollar is getting stronger. U.S. yields are going up, and so that spread is pressuring them to take action sooner rather than later. Um, but they're gonna have to do something. And losing that little bit of inflation they had going for them and losing that positive growth rate just accelerate that. I think they were, already planning on falling into somewhat of a recession. However, that, yeah, I mean, it does make it harder for them to increase rates at that point because obviously the pain felt from doing so, locally in their economy will be far worse than it would have been if they'd done it while they had, growth and a positive, inflation rate going for them. But I mean, I don't think anything really changes on that front. And as we can see, the carry trade is being levered up, and it's being levered up quickly. We've we're almost back to where we were mid-November. Um, and we're about halfway to the peak we were at at the end of October. So U.S. banks aren't going to waste a second leveraging this up if they don't think that there's risk. They need it. It's the lifeblood of the U.S. U.S. lending. So yeah,
Definitely interesting. I I'm still not sure how I want to feel about how this all functions, but you know what? What can I do about it? America, fuck yeah.
yeah. I mean, I agree that we should have protections in place from this kind of risk being taken. But what other? I mean, as a bank, what other choice do you have? Right? You can't go to the Fed because you can't, especially with your massively underwater mature holdings. This is really the only option that's beneficial. This is the only way to get extract value from those assets, and otherwise, you just cease lending entirely. I mean, at least for now, this is stabilizing the banking system to a large degree.
I mean, you don't have to cease lending. It's just you have to demand a lot more from your counterparties.
Yeah, well, okay, but I mean that's effectively gonna kill credit,
Yeah,
right?
I know.
Yeah, it's the same thing.
Well, what's interesting about that too is that this all comes back to the options market, doesn't it? Like how if that happens, right, and that spread collapses, ROVA is going to have a huge impact on the net hedges of market makers,
Oh yeah, yeah.
because a lot of their strategies are replicating strategies that are levered in one way or another.
That's why I bought the 12,000 Cs for 2027.
Hey, you know what? If you expect the carry trade to collapse in the next 3 years, that's not a bad plan.
What blows my mind is the fact that the second rate cut started coming off the table, the banks went right back into the carry trade as hard as they could. um,
Oh yeah. Well, like they want to keep credit conditions where they're at, right? I mean, that's like where we're at is I feel like from a debt market perspective, fairly sustainable.
yeah,
Uh, so like just from for America, it's a fairly sustainable level, and I think they want to hold on to that however they can. even if that means exporting more inflation to other countries like Japan,
And then
who have these low
I
rates.
told Popcorn I would try to explain our little chart here and what it means. And so this chart isn't actually directly related to the USD JPY swap that we've synthetically created here. This is the bond curve for the 10-2. That's what we're using on this, right? And this is
I
the
believe
yield
so.
curve for volatility. And so, something I predicted at the beginning of the year was that we would see some of this cyclical behavior between vol and the yield curve, where this is your bull steepener. I hate writing that word. And this is your bear steepener. Right. And so this drove all of the price improvement on SPX. Everyone was elated. Vol was dropping, right? But Vol didn't drop very much, which is interesting. Um, but everyone was excited. Rates were going to get cut. We started to get that bull steepener, and that's just immediately reversed, and pretty quickly over the last couple of weeks, and we're right back into the bear steepener again, and that's putting pressure on the forward returns of volatility, and basically what this is it's the yield on forward vol convexity. And right now it's negative, right? But if it moves positive, what happens is that the demand for volatility significantly increases. And we got like a little window of positivity a couple of weeks ago. It was immediately crushed, but the trend overall is still moving towards positive. And as the yield curve steepens on the bear side, that demand for volatility is going to keep picking up, and then once the returns on volatility are positive, they become positive exponentially faster. And historically, if we look at the reaction to that, it doesn't happen often, right? Usually volatility returns are pretty muted. Um, but in periods where the yield curve drops and forward returns on yields become negative, and forward returns on volatility become positive, you tend to get crashes. I guess that's the best way to put it. I probably have to go out on the weekly here for you to really get a full picture of it. But you see some of that here in '08. Um, and this is after rates were cut, right? So we had everything up until rates were cut, and then rates get cut, and then volatility demand spikes, and then that's where you kind of get your crash. We saw this in 2020 as well, with the rate cut going into the COVID crash.
Yeah, and this all comes into like the, what essentially happens in the lending market, right? When someone gets an auto loan at 5 years, that gets borrowed at, in a normal yield curve environment, that gets borrowed at the 1 year and then lent out at the 5 year, and it's basically that's like a convexity long, right? And so the way you hedge that is by a basic. You need to hedge the yield to maturity value of your bond, and the way you do that is through either before it was just by like doing other sorts of like basis trades or convexity hedges on the yield curve, but since volatility futures came out, what you can do is you can actually short vol convexity to hedge your yield to maturity risk. But that relies on the volatility forward convexity being negative, because then your risk is very well defined at the low, and it's very self-propagating with the bond market. When the convexity turns positive, that hedge, one, no longer exists, but two, if you were to enter it because you were, say, uneducated, you would propagate forward vol demand, right? And that's why they say vol demand spikes. It's because this convexity hedge inflects, and
Yep.
so a lot of this hedging basically turns from being short volatility to being long volatility.
And long volatility is exponentially increases once it occurs. So like once so when you're short vol, it has diminishing returns, and when you're long vol, it has exponential returns. So if you get a shift from vol convexity to long vol convexity, then everybody needs to go long vol at once, because the returns keep compounding upward instead of reducing as the position becomes more crowded.
Yeah, and there's also a good amount of losses to be had if you don't, you know, if you don't catch this in time, you can, your hedge could break down, and that's usually when we see the bond market start to do weird shit as well, is when because the losses compound really quickly when that kind of shit happens. When your spreads collapse and your vol convexity turns positive, you know, especially like when there's like an emergency rate cut or something like that, or like a big rate cut that was unexpected for how big it is, your entire portfolio undergoes a major shift, and it's danger times.
So it's a perpetual squeeze. It kind of squeezes till it breaks.
It's not really a squeeze because these are futures we're talking about, right? But it's a constant short. It's the market call, right, to the Fed put,
Well,
right?
anybody short vol convexity at the point at which vol goes positive technically gets squeezed, right?
Yeah, they do. They do,
So,
but it's not
yeah.
like it's compounding.
No, but the long vol is compounding. So they're long. I mean, should they
Yeah,
stay short vol and not like it basically it forces any informed investor or any investor holding a bond portfolio to go long volatility simultaneously.
right. And that's what's funny is that actually puts the whole hedged position more in line with a traditional bond portfolio of old.
Yeah, yeah, it does.
It's funny because it's like it's you go counterintuitive when things are stable, and then you go back to traditional for like it's only when the risk is present that people are actually like, we need to behave rationally.
Yeah. Yeah, but when they need to behave rationally, they all need to do it at once. And so, yeah, that I mean, it's generally a driver of market crashes because it's such a huge liquidity demand, right?
It's a huge shift. It's a gigantic flow. It's a like the bond market is gigantic. So when you
Yeah.
got like BlackRocks who have a huge bond portfolio, your non-banks and your banks all, or your good banks, at least like your JP Morgans of the world, all having to shift the way they hedge their mature their not only their interest rate risk, but their vol convexity risk, their currency risk, their carry trade spread risk, right, which has its own currency pair risk inside of it. All that shit changes on a dime when the yield curve starts to, we call it re-steepen, but it's really just like when it goes flat, right? When it de-inverts, right? There's just a huge change in how the entire financial market is like stabilizes itself. And so for that brief moment, kind of like the way a speaker passes the center point of its like, magnet, how like they call it the aperture time.
Yeah.
As it flips past that aperture point, right, you get this big spike in volatility because, overall financial market liquidity is very strained. And that's when you get things like money markets not being able to reflect their NAV properly.
Don't tell people that are fully invested in money markets that dork.
You know what? I had a brief discussion with Atomic about it. He had a bunch of money in money markets back in 2008, and he said he only like he couldn't get his money out for like I think it was like a week or something, and then he had like I think he lost like 80 bips or 1% or something to it. So it's not like the the risk is super huge unless you're in some shady ass high yield money market shit. Then you're probably actually buying junk bonds.
Yeah, I mean, generally any UST supported money market, the maximum risk you're taking is your liquidity is going to be tied up for 3 to 6 months.
Yeah,
Um,
yeah, that's about the worst. Or you miss out on, and because of that, you miss out on like a really loose credit market because money printer go burr.
yeah, yeah.
But
So what's really important here is not it's not yeah so it's not that obviously we've had week long periods in the past where um, forward returns of volatility have been positive, but during those times the forward yields is negative. So it's very specifically when volatility turns positive and the forward return on yields is positive,
yeah,
right?
yeah,
These periods like what we're in now, where yield the the bond curve is positive and vol is negative, this is when a vol, like a spike of positive vol, it needs to be crushed immediately. Otherwise, yeah, it can flip how bond portfolios are dynamically hedged overnight. And this is what we saw in COVID. This is what we're seeing now. This is what we saw in '08. If I go back to '08, we see
I think we
this
saw it in
period
2000
where,
too.
yeah, you do, but we don't go back that far on this chart. Um, and you also see it in the 90s as well, like the early 90s. But
If you just look at VIX, right? Yeah, there weren't really VIX products, but when there was VIX and VIX options, you can sort of replicate this with those.
yeah, you can. And so yeah, it's these periods that present the highest risk, where that bond return is positive, and then vol moves positive, and usually it resolves very quick, as you can see. It just leads to a crash, and then it's resolved, and then yields move back deeply negative, and this is a period of financial stability, which actually, since we actually were relatively stable through most of 2022, and the risk didn't really become apparent in 2022 until the bond curve started to move towards positive, which was around Jan. And then this is the bank failures, and this is now, right? So but if we keep seeing bonds go up, right, yields go up, we're going to continue to see this pressure mount, and that's going to put pressure on vol, and we're going to see more and more periods where vol can spike like that. And I mean, I'd say we're in one now. This is October. This was the peak. That was the bottom in October, where we almost crashed, believe it or not. So October 23, we came pretty close to crashing again. Maybe the most since like June of 22, or March. I guess March of 23, and then June of 22.
Yeah, when when you see, and so when the bond market bear steepens, right? When the long end rises like that, especially, you have to put into context, right? So when the long end of the yield curve rises like that, with how much hold to maturity losses banks are sitting on, you end up with and especially with the charge-offs they're going to have to start picking up on for CRE, that's more of a regional bank issue, but there will be knock-on effects, and credit card delinquencies increasing to the 90-day delinquency stage where you're going to have those being charged off as well. You're going to have a demand for cash, and these super illiquid hold to maturity assets are going to become a bigger and bigger drag if the yield curve, the long end, continues to rise like this. It's just going to become a huge drag on global financial liquidity, because you're going to have a ton of people who need to go and do these charge offs, sell some treasuries to get some cash, and you're going to have other people who see this happening, who are seeing the risk, and you'll see like short-term treasury. The de-inversion is going to be really interesting to see when it happens,
Isn't the
and I
other
feel like
so Poopy says, isn't the other side of this that it gets stabilized, green line go down, and we rocky? Um, So that's the fun part, is there is no stabilization. This is inevitable. The resolution of this must come to pass. We rock it. No, yeah, there is no as you can see, we went up 20 fucking percent in the last couple of months and it didn't uninvert. No, this only gets worse until it all resolves.
Unless it resolves, like, okay, so if we wouldn't rock it, but there is a scenario in which this de-inversion happens so frustratingly slowly. Like if it happened over the course of 4 years, right, from such a huge disparity between the short and long end, if it happened over an incredibly slow period of time, we could end up avoiding a massive credit event. But with how much risk is packed into the bond market right now, it's hard to see that coming to bear unless we allow a good portion of these hold to maturity piece of shit securities roll off.
So yeah, that's kind of my, like, when I made my, like, beginning of year prediction, that's kind of what I was talking about, is that we see this constant cycling of this position over, and this is like the hard landing, right? And this is why I think it's more beneficial, because the banks actually survive it. Is this just goes on for years. I don't see a path to this. I think risk is way too high, but that's what would have to happen. Is this would just have to go on for years and years and years until eventually, you know, yeah, like I agree with Dork, 4 or 5 years down the line, we start to see yields slip back into that negative return.
Yeah,
But
each time that happens, you have to make, like, the thing is each time that happens, you have to avoid the next soup du jour of credit events, right?
yeah, and but the thing is,
SVB.
yeah, every time it contracts again, you're looking at another potential for a credit event, and that's a lot of times to roll the dice, especially if it's happening as cyclically as every quarter, right? Look at August, September, October. Look at November, December, Jan, right? And that's the exact that's the cycle, right? It was like into March last year, and then March to July, we had the positive cycle, and then we had the negative cycle from August to October, and then we have the positive cycle from November to January, and now we're entering the negative cycle again right now, and it like that credit event risk just explodes, right? And every time, everyone's a little more over leveraged, everyone's a little more greedy, right? And yeah, I mean, I don't see a situation where the Fed can keep this constrained forever. But I think that the labor market and the Treasury um, have all have all done a lot to prevent this from blowing up. But like in October, on 23, the 10-year came right up to that 5% mark, and that's where all that bank, like the fair value asset risk for those banks quadruples when the 10-year hits 5%. So right now, 10 years above 4%, we've already got like 1.26 trillion in fair value assets that are at risk, right? We saw some of that pressure over on NYCB during this period, right? If we see the 10-year move above 5%, that's gonna bring 3.6 trillion more in fair value assets at risk.
Yeah, and notice too, that this time around there's a new soup du jour of sorts of the news cycle as well. Now everyone's all of a sudden, CRE is becoming this big worry because a good portion of that, like, so CRE is on, like, I think it's like 3 to 5 year leases on properties, and a lot of that's starting to kind of come due, where people are either going to re up on their lease or they're just going to let it fall off, right?
Yeah.
And that's kind of why it's coming back in the news, which I find interesting because we've known this is an issue for such a long time that now the news is going, oh my God, like it's kind of stupid. It's kind of stupid, but it coincides with sort of this increase in risk in the credit market, and you're seeing high yield spreads sort of pick up as well. So it's going to be an interesting time over the next few months while we see this start to happen. I'm going to be very interested to see how Blackstone's earnings perform over the next 2 quarters, because Blackstone has a very large exposure to CRE. They buy assets and make them better. Some of those assets happen to be office buildings. Yeah, that's a good way to put it there, Girk.
I mean, this is something that has gone on in perpetuity for the history of the market in one form or another, right? And no one really pays attention to it, but it's there, right? And like as you can see, going into the 2008 GFC, we had the same cyclical behavior, right? Bull bear, and then every time that cycle goes through, yes, poopy pants risk compounds, and then eventually that risk is realized. But no
Well,
one,
it's
no
like
one could tell you how many cycles of this that we could go through. I mean, depending on Fed narrative and things like that, it could, we could drop 15% on SPX over the next 2 months, and then in June we could run 20% again, right? And then just rinse and repeat, and that could keep happening. Um, but something's got to break, right? Between the yuan and the yen and the dollar and Fed rates and inflation, this all can't persist forever.
yeah,
Where
it's
it's going to break, I mean, no one knows, but it will. um,
It's funny, you see the behavioral pattern too more broadly is risk taking increases as you head into a recession,
yeah, yeah.
and we're
Historically,
seeing
historically, employment's really good going into recessions too.
everything
Um,
looks great heading into a recession. That's the thing. Like I feel like this is a rerun of 2008 where we were worried about rate hikes again right before the entire fucking market just exploded itself.
so this, yeah, and this is like one of the reasons when people are like, why do you think we're in a bear market when we're obviously up 25%? It's because of this. Because this is going to become a bear market at some point. So, if you're in a bull market but there is an inevitable collapse ahead of you, are you really in a bull market? I mean, these are nice stable financial condition periods, right? And they're huge. They're 2009 through 2018, 2021 through 2023. And this was way more volatile, obviously, but it was still relatively stable. Like this was still a bull market. This shit is not.
If we had more of them, it wouldn't be too bad, but we don't get enough of these things because those periods you're circling are those lower periods are money printer go burr. Like
That's true.
when money printer go unburr, things get really shitty, and it shows how modern monetary theory, right, it sort of breaks down, right, and how it breaks down. I mean, and that's part of the Fed's problem here is that they do have to fight inflation. That's why they forced this bear market upon us. Is because if they didn't, our prices would be going up so fast that they would effectively have engineered one of the worst economic crises in the world. And we think GFC is bad. GFC was bad for different reasons, but a hyperinflationary, global recession is way, 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 way worse than a deflationary recession.
Yes.
So yeah, obviously they're making the right moves. I hope the next Fed
So
meeting they just
green
say we're not
curve, 10-year, 2-year. Yeah, I'm not going to give out the methodology, but it looks at the 10-year, 2-year. It's not the 10-year, 2-year.
really.
Um,
I don't even know if that's. I think it is the 10-year, 2-year, but we've played around with it a bit.
Quite a
Just we're just
bit.
trying to do the salt-based salt sprinkle on it to get it just right. Okay, Bob. Like, look, like we always say that war make money printer go burr, but I don't want to believe that we will always resort to a
We
war
need
to
a
bring our
big
economy
fucking
back.
war for that kind of natural growth. I mean,
Yeah,
into the future, provided the money printer no longer goes burr for 10 to 15 years, we should see this move down but stay stable, right? And we won't get those big expansionary periods so much, but we will have, vol will just stay relative a little bit negative, but with the occasional spike positive. And then,
yeah,
but we won't get those deep moves, where um, QE has just pushed growth to the max, right?
yeah. I really hope we don't end up with that again. Your soft landing scenario where it just fucking tanks down to fucking zero again. Yeah,
Yeah, that would
but
be
I do
bad.
not want that because then we're just guaranteeing ourselves another one of these crazy mega cycles, which is just not sustainable over the long term. It's going to make people more and more upset with their government. But yeah,
Yield, CMBS, Ukraine, Middle East, and now the Pacific. You know what no one's mentioning? The massive wall of corporate debt that needs to be refinanced in quarter two, quarter three of this year. It's gonna be really interesting when we hit summer and 350 companies have gone bankrupt. um,
yeah,
there's a shitload, and no one talks about this, but there is a shitload of short term maturity corporate debt that was piled into at the beginning of the pandemic, and a lot of it, a big chunk of it's coming due in the next 2 quarters. And we were gonna like bankruptcy spiked last year a little bit. We're gonna if yields remain where they're at and the federal funds rate doesn't change, which doesn't look like it's going to. When we run into that wall of maturities, it's gonna be ugly. It's gonna be really ugly. There's gonna be a lot of companies that go under.
well, we got debt maturing in quarter three, quarter four, next quarter one, next quarter two, next
Yeah,
quarter three. It's just so
but
much of it. It's just
I think like
one shot.
23% of the debt issued in 2022 is going to be due for refinancing. Uh, like double A corporate debt, double A triple, double A double B, triple B. I think all three have massive walls of maturities coming up, and those are gonna get refinanced at 5x what they were issued at.
Yeah, and these are the companies that are the ones giving Google and Nvidia and Meta and all that money.
Yeah,
So just to put that in perspective too, and that's why I said it's crazy to me how they make up 6% of nominal GDP because they alone, if tech hit a slump just by itself, it would put us in a recession.
oh no, companies will have to be ran well again. Well, that's why I'm so bullish going into the end of this year, next year, on like small caps, mid caps, um, and emerging markets, because I want to find those companies with low debt, solid cash flows in industries that are going to be largely undisturbed by the greater financial fallout, because I think those are where investors are going to need to turn, in order to realize consistent growth moving forward.
Oh yeah, positive FCF is, a must, and even not even just low debt, but even having a decent amount of cash on hand is going to be huge, especially in a downturn. You want a company that has a moat to be able to weather it and maintain operations, like not have to scale back their company. Because when you that's like they say that the reason why unemployment doesn't go down or doesn't go up generally is because when you scale back operations like that, it's way harder to recover from when you like trying to bring that head count back. Those people, there's no guarantee they're going to be sitting there waiting for you to offer them a job again. You're probably not going to get it. You have to rebuild your teams, and that's a huge hurdle to overcome. So you want to find companies that will not be facing that problem. And that's why the smaller companies is a really great idea, because they're way more reticent to reduce headcounts in response to economic issues.
Yep. Curious your thoughts on VFC. Bracken Darrell seems to be the RC everyone wishes RC was. I don't even know who the fuck that is. Sounds like GME. No, GME is missing one of those components. It doesn't make money. It just cuts costs. Its revenues go down. That's not what you want. You want something that's revenues are going up, cash flows are up, and they're trying to trim overhead. Right? They're making money. GME is not making money. They're bad at making money. They have like no growth prospects. This is the problem. I would have stayed long GME had this issue not arisen, but RC has no plan for growth in place. Even right now, even if RC lost, GameStop lost one of its biggest competitors, let's say Target or Best Buy or somebody went under. We hit a recession and we lose one of the major players in that sector. GameStop has no plan to take advantage of that, right?
Oh yeah, if we lose one of those companies, I guarantee we're losing GameStop.
Probably, yeah.
Like if Target goes under, dude, GameStop's already been under. Well, I guess the thing is they're too exposed, right? They don't have some sort of insular edge against those other big retailers, and in fact, they are even more exposed to economic trials and tribunals because they don't have like a diversified asset base like Target with groceries and stuff like that.
Yeah. They closed all the things we were bullish about. Yeah, they did.
Exactly.
They gave up on everything that there was to be bullish about. So I mean, as far as a company that's just sitting around and trimming costs, like sure, they put themselves in a good position to survive, but that's not what you want out of a company. You don't want to buy into a value trap, right? You want to buy into something that has potential, has growth. And GameStop's done nothing but eliminate all of that potential over the last year and a half. You're telling me the NFT marketplace won't make us all rich? Never was gonna.
There was a possibility. I talked about it a little bit, and everyone seemed to poo-poo me, but
Yeah,
there
for
was
good reason.
there was a path to NFTs being a cool thing, but the amount of capital it would have taken is a lot, especially for like a third party thing. But blockchain, blockchain serialization like that, and I don't even know what you call that, but serialization essentially of the blockchain does have real world applications with anything regarding uniqueness, and it would have been huge, in this world of AI where you could actually have a token attached to your media that someone would have to buy in order to use it, and then you'd have a much stronger case with AI generated content. And you could actually sell your content like a token to your content to these AI makers. But not only that, but hardware verification, account verification. So like a video game account, um, those sorts of things. There is a really good use case for it, but GameStop made it about fucking monkey drawings and shit like that, which would like literally just JPEGs. Which when I saw that the market was just JPEGs,
I mean,
I
you
was
could
cringe.
actually, when you train, you know what would have been cool is like when you train the LLMs, right? You could have a tokenization inventory for all the media that the LLMs are trained on. And then when the LLM outputs, like, say, a video, like a 2 minute video, and, say it uses 30% of, 30% of like this token, right? And then like it uses like 5% of this other token, and it's using those media inputs into the LLM, and that combining those to make the output, right? But then the output would have, when the output's made, it would have a strict structure of royalties due on that tokenized blockchain. and then you could, then royalties from whatever output media is created would be paid to the owners of the original media content, and then any additional profits would go to the whoever made that content, right? And so that way you could create an economy of scale around these LLM outputs. Instead, they're gonna just kind of turn into fucking lawsuits.
Yeah, yeah. The thing is once you do that, Girk, it becomes prohibitively expensive.
Yeah, no, I get it, but maybe not as expensive as the lawyers will be.
That's
Anyway,
true. Yeah, but there were paths for it, but yeah, GME's a shit stock. They're not doing that, and so who gives a shit?
big dump
It's
in
one of those things where
skew, so big shift in demand for tail risk. That's what skew tells you, right? It's telling you that there was no demand for tail risk, and now there is a bunch of demand for tail risk. A lot of out of the money puts came in into the end of last week. Obviously, none of the data, especially the hot PPI print on the back of the hot CPI, not just hot PPI print, very hot PPI print on the back of a pretty hot CPI print does not paint a bullish picture for either inflation nor federal funds rates over the next 3 to 6 months. And so, yeah, we saw a big spike in demand for tail risk, something that has been being sold in very, very large numbers up until this point. So there's still a ton of short tail of positioning that's very exposed right now.
So you're telling me that rising input costs and fairly flat consumption is bad for margins? No way.
Dork, I told you my only bull case was that PPI keeps going down and CPI keeps going up.
Uh,
Right? That's the best bull case I've ever come up with. It took me a year and a half to get bullish on something. But
it's pretty
if
cheap.
there's one
Yeah,
thing I can get really bullish on, it's that corporations will always fuck the consumer. And so I think and I think informed investors are doing this as well. But over the last few months, we've had PPI down, deflationary even, right?
yeah,
And CPI, fair like up to flat and now spiking, right? Except now this is going up and PPI is now, well, as of the last print, has also reversed, right? And if this spread closes, big bear. Now either
yeah.
CPI drops, that's big bear, or PPI goes up, that's also big bear, because this means that the input costs are higher. And that's going to lead to margin contraction, which is what everyone was afraid of when PPI was going up in 2022. Um, But as long as PPI is deflationary and CPI is flat to up, then all of the costs are being all those costs that are reducing are still being just pushed out onto the consumer, right? So input costs are going down, consumer costs are staying flat, which means people are just paying more, getting less, and that's bullish. But
Eh,
but
yeah.
Friday's
Yeah.
yeah Friday's data not bullish, not bullish for corporations.
Well, it's funny. Like,
I mean, like,
are and
I know you don't ethically, that's not bullish, but
it's funny because that bull case, sort of rides on the idea that we can much like we do with margins, we can push like the limit of the consumer has not been found, and we are bullish on the pursuit of that limit,
that's
right?
well, that's why I wrote that DD yesterday, because I wanted to kind of create a visualization for people where that limit exists and how close the U.S. consumer is to that limit, which is close. We're very close. Defaults on single home mortgages are going up. Credit defaults are hitting all-time highs historically. I probably need to write an entirely different DD for auto loans. Like, it needs that market's so fucked that it needs its own DD separate from the one I wrote. um,
Well, yeah,
because you want to talk about underwater loans, that's where they are in massive numbers. I mean, you're something like 60% of the cars financed in the last 4 years are underwater.
I wrote a DD on this back in 2021, but
Yeah,
Twitter has made it disappear
I
because I
remember
was
it. If
off.
that's any consolation.
Yeah, and I talked about this a little bit at length, where like it was especially predicated on this whole gig economy thing that's been happening. You know, even though the pandemic saw work from home begin, the gig economy sort of just flew right in the face of that, as well as crazy financing. The fact that you could buy a car, turn around, and sell it used for more, like this weird arbitrage that existed, like all that shit. All that culminated for me and was just this just very rapid credit bubble just showing up out of nowhere, and it happened. And then but much like housing, right? With cars, they're depreciating assets, so you're pretty much guaranteed to be underwater on them, especially if you're buying on like a really rapid appreciation. um, but the issue becomes when your car breaks and you need a new one. It exists on a distribution, and some people are going to have that happen to them. um, so there is an equation to be made where you can sort of calculate how often a car breaks within 5 years of buying it, and you could come up with how many of these people are just absolutely fucked because they still have a fat giant pile of auto debt, right? um, and in there lies the economic impact for the auto loans themselves, right? And cars are funny because you need one to get groceries, because a vast majority of housing in America is in a food desert. um, it's just all extremely interesting, and I'm not exactly sure how it's going to play out. I think it is the for the next 3 years, it's as big a risk as CRE. Whereas I don't really see uh, RRE um, as huge of a risk right now. It'll become the next big one after those auto loans are paid off or paid down. Um, but yeah, it's all just it all kind of plays into that whole idea of the cycles. I mean, CRE and auto loans may end up being enough if there's charge-offs on both of those at once to really cause some serious problems, and then from there RRE becomes an issue. But um, I'm kind of in like, I'll see it when I'll believe it when I see it sort of state of mind right now on that.
Can we tow them out of the water? That's crazy. Why can't people drive anymore? The cars aren't physically underwater. The loans on the trash. Some drunken idiot totaled my car and I had to buy a new one. 5.04% interest. My old car was valued at a higher price than I bought it for 5 years prior. Yep, that's a problem.
Well, you bought
Ivy
it in
is
2019
historic.
then.
I mean, but for during the peak in 2022, beginning of 2023, we're seeing like people pick up like 6 7 year loans at like 10 to 14% interest on new vehicles.
So
Um,
a good some good anecdata is at our personal finance, where there's people who are broke and they're like, "Why am I broke? Here's what I'm spending money on." You see their car payment is like $650. Like, and they don't make very much money, and they wonder why they're broke, and they probably bought it in 2021 or 2022. Like, there's a good amount of people who bought cars in 2021 and 2022. That's why they got so fucking expensive.
yeah. Dork, I sent you some data on Carvana. Everyone's a little interested in this, and then we'll wrap everything up with SPX
Okay.
before the 3:30 mark. But looks to me like people are getting pretty bullish on earnings for Carvana, which are tomorrow. But if those miss, it looks like it could collapse pretty quickly. Um,
It looks to me like they're getting pretty bullish on puts.
well, here's the deal though. Meme stocks are weird when you see that go up.
It's true.
Yeah, if you look, yeah, if you look at the prior period, sometimes sometimes that's more a lot of short puts closing, not a lot of long puts being bought, right?
Okay, I see what you're saying.
So I think people are gonna approach it from like a slightly bullish to neutral standpoint. Then if they miss, it'll probably tank super fucking hard. It's pretty close to Gamma Max already, where it's trading now, and Gamma Max is at 60.33. So, um, even if it shot up after earnings, I might short it.
Dude,
But
talk
you
about a Moab. They were $5 in 2022.
definitely a bit of theta on that one.
uh, what a
Yeah,
fucking
I mean,
scam.
I ultimately think that this company is going to go bankrupt, but they've survived so far by accumulating even more debt. But their inventory is constantly losing value.
Yeah, their inventory is losing value, and I feel like they're running into like legal issues and like things like that. Like I've heard some horror stories about people buying on Carvana and like not getting the title sent to them for like months, that kind of shit.
Yeah, I mean that's also because their ingest for inventory is like the sloppiest system ever developed. But it's I don't think they're going to last a long time. And they if they do go under, expect cars to get very, very cheap. So I want to say that I won on SPX. I won bigly. I don't. You came close. Actually, no, I didn't win bigly. You almost
With
got
my
it. Your
flat
50,
prediction,
your 50-25 flat prediction was off by $20, and my end of week 5,000 prediction was off by $5. So I did win.
damn,
Um,
we were
JFresh
so close.
lost, which was probably the best part of the week. um, but I don't think any of us really suck. CPI being as bad, or take the market taking as big a hit off CPI as it did. I will say though that this all looks very bearish from a technical setup.
Yeah, the market really did overreact to the CPI print. And I found that interesting because, rather than thinking that it's just like, market go down, and that's why I still said we're going to end flat on the week.
Yeah,
But what was interesting about that is it does show that there is some sensitivity. Uh, there's a lot more interest going forward in inflation, right? Like this last little bit is the hardest bit to get rid of. And so any sort of signs of reversal are really bad for the bond market.
yeah. Well, it's not just that. I mean, we were so massively over leveraged to the upside when the CPI print hit that we just fell through. Like we basically fell through every sold put on the chain within a one and a half sigma move, right? So all of those short dated sold puts, like all of them went in the money. Um and I mean, so I think part of it that yeah, there's a lot more sensitivity to forward-looking inflation projections, as there should be, right? Given that
Yeah.
at the start of this run we were pricing in 8, and now we're down to 3 cuts. Um, so yeah, I would say that a lot of our price increase has been artificial on the back of hopes and dreams that we would hit those targets, which we're obviously not going to hit for a very long time. But also just yeah, I mean the volatility represented by the positioning, especially short put positioning near the money on SPX is scary.
It showed a lot of ROVA exposure. I mean, like all the bond market spikes we've been seeing, like it's just there's a lot of risk packed into the options market right now, man.
Well, we
It's
priced out like 3 rate cuts like that on the CPI print.
yeah.
Yeah, it was like March. March was gone. June halfway gone, and then like most expectations shifted to July, but even lower, right? So it was a big shift in the like Fed Fund futures projection and the swap lines. So that drove a lot of vol. I mean, which we saw. VIX spiked to like 17 pretty quickly. I think PPI comes in and cements that though. and
I think
I'm
you're
not
right.
I'm not feeling super bullish about this coming week because of that. But I will note that Gamma is still positive on SPX on the monthly, just barely. We ended the day Friday just with just a little bit of positive Gamma left over, but we did drop. Oh Jesus, 22 billion in charm off of the monthly expiration,
Ooh.
and we saw 10 billion, well, 9 billion in charm fall off the weekly expiration. So almost 30 billion in charm falling off. If that doesn't leave us flat tomorrow, it's probably going to see us fall even further. Um, some of
Yeah, we just
that
got to make
padded
sure.
by some new vol selling coming in. We did see a bit of increase in Vega exposure, so they are still selling puts. They haven't stopped, but I would say not nearly enough yet to pad that. And something else Friday is we saw calls exiting the chain and long puts coming in out of the money. That kind of behavior is not generally indicative of when we see a recovery after charm falls off on OPEX. So this does not look particularly bullish. Um, I would be careful because we are still above gamma neutral, but I think GN on the SPXW is at like 5,000 now almost 49.74. So we're opening this week like right on top of GN, $25 off. That
It's gonna be an
gives
interesting week.
yeah, that gives the Bears a very nice target right at the money to really drive shit down. And remember, as GN gets closer and closer to spot, the risk of falling below it increases. And if we do fall below GN and then GN on the monthly, which is a bit lower, that starts to open up delta neutral. And if we fall through the delta neutrals, then you're just kind of in a free fall. So yeah, those are definitely the levels we're going to be paying attention to in the coming weeks.
Yeah, and it's going to be important to look at Vega exposure too, with all this interest in the short vol trade, right? As we fall, we're below Vega neutral at this point, right?
Yeah, I believe. Well, I mean we're way below SPX monthly Vega neutral, but I think Vega neutral on the weekly is at
That's the one that matters.
50.70. So yeah, we're pretty far below it.
Okay, yeah, for sure. So yeah, once we fall below gamma neutral and we're on our way to delta neutral, um, my prediction is we are going to see a reignition of the V. I think that's going to become a thing again. Just because with the negative gamma and negative vega, uh, put selling can reverse a downtrend fairly strongly, and so we may just see
Well,
on the
that's
way
only
down.
that's only true up until we hit gamma neutral. Once we fall below gamma neutral, that's when the V starts to weaken.
But well, depending on how far away we are from it,
Okay, yeah. So yeah, if we're like 30 bips below gamma neutral, then yes, it can still be V'd. But if we fall like 100 bips below gamma neutral, the V is not going to have a lot of strength, and it's going to have to turn around a ton. At any point below gamma neutral, you have to turn around the market maker's sell pressure, which above gamma neutral is not something you have to deal with. So I think, I mean, not to undermine you here, but I think the range between GN and VN is the most bullish range. That's the range in which V's are guaranteed. Any drop that's stopped above GN is going to reverse. The market maker is going to be buying that dip, right? Um, but below GN, the market maker is selling into that drop, right? So I mean, although they will start buying the reversal, they won't buy until it's reversed, which makes
right?
it a
That's the
lot
thing.
harder to turn it around. Although if it does turn around below GN, the upside move can be daunting, as we saw earlier this week, right? With
Yeah.
the fucking crazy bounce. But yes, but we weren't really below GN there, right? Like we hadn't fallen below GN on the monthly. We were just below that weekly GN. Remember that those don't have as strong effect as the monthly ones do. The monthly neutrals are far larger and more impactful than the weekly ones.
Yeah, net exposure is going to be huge here, and but part of my prediction of the V is that it comes back to my social analysis that risk-taking behavior is going up. So
I don't know,
someone
man. Have you
coming
looked
into
at Twitter
the
this weekend? People are scared again. I like it.
are they?
Yeah, you can feel it tingling in the air. The fear.
That's
Yeah, I mean,
true.
of
Yeah,
course they're fucking scared. They just bought Nvidia at 725, and the market didn't end up at the back half of the week. Like we had a red week, Dork. Red
oh my god,
candle.
no,
Red candle's the scariest thing in the world for bulls.
that's true. That's very true, and that's why they bought a shit ton of puts.
Yep.
Well, okay. I guess.
I'm gonna assume JFresh's prediction is just vertical upside. He didn't tell
Yeah,
me.
just you can just scoot it over. He's a perma bull.
Yeah.
Wait, no, but that was to OPEX. Now that OPEX is done, he's probably going to stay straight down
Oh fuck. Why didn't he just tell me?
because he's busy having kids vomit on him.
I'll update the quant dot plot with JFresh's prediction when he gives it to me. For now, it just doesn't exist. All right, Dork. Are you going
Uh,
first or me?
I can go first.
Okay.
So yeah, just take that and put it at the bottom of that red candle. There you go.
Which red candle? Down here?
Uh, no, not the wick, just the body, just the close. I think. Well, actually, okay, wait. Okay, I actually need to update this. Okay, so flat until Wednesday,
All
and
right.
then
Hold on. I gotta.
you got to add some point. I know it's going to be a simple one. So flat until Wednesday, and then close the week out at 49.50.
We got a short week too, huh?
We do. Yep, looks about right. Actually, no, it's at the end of day Wednesday though. So take that middle point and scoot it over to the other vertical line.
Oh, all the way through Wednesday?
Yeah, because
Oh,
Wednesday
okay.
closes the video earnings, right? So yeah.
Yeah. All right. Huh. Okay. I feel like we open. Fuck me. You might be right about the flat.
That's why I wanted to go first.
Bastard.
Ooh.
There we go. Should I do Bulgurk?
Yeah, go ahead and do bullish Nvidia earnings.
Okay.
Yeah, where's Gamma Max at? Yeah, just right up to Gamma Max.
Yeah. All right. There's Bulgurk.
That's kind of what the market's telling us is going to happen.
Yeah. Yeah.
One of the two.
Bulgurk is always right. I didn't get a Bulgurk last week. JFresh took it away from me. But Bulgurk would have been wrong because Bulgurk would have projected He would have projected the upside. Just Girk was spot on closing, but CPI was crazy.
CPI was nuts. The bear flag off of CPI was so fucking crazy, so steep. That's a V right there if I've ever seen one.
You know what? Actually, hold on. Girk's gonna need to get a lot more bearish.
Oh Jesus.
He does. I mean, because if we fail this week, we're gonna dump like a fucking brick.
That's true. Yeah, we will.
There's so many short puts, yeah.
Oof.
All right.
Oof Magoo.
It looks like the most gigantic megaphone I've ever seen. I'm not gonna lie, I'm pretty bearish, but I know Nvidia earnings is super important, so I've gotta temper my expectations a little bit.
Yeah, I still expect Nvidia, like you said, it would not surprise me at all if Nvidia met or at least met expectations. There's still some time on that. There's some meat on that self-funding bone.
Ugh, gross. Yeah, I know.
It's so gross.
We gotta move these anyway. All right. Well, thanks for coming on, Dork. I appreciate it. Even after you've made such a daunting trip today.
Yeah, for sure. Now I gotta go find a place to eat. I am currently staying in a food desert, so that's gonna be fun.
Oh wait, are you staying? Are you staying in the Inland Empire?
Uh, I guess I don't know what the the boroughs of LA are. I'm staying at some random ass hotel in the middle of random ass part of LA.
Oh, okay. It shouldn't be that bad of a food desert if you're in LA County.
Yeah, there's some stuff around, but I gotta drive for like 10 minutes to get to it. That's the only problem.
Oh yeah, yeah. At least 15. Just assume a 15-minute travel time each direction.
But what if I want to get drunk? There's no bar at this hotel.
Go to Hollywood.
I guess, or I could just go to a liquor store and pick up some six packs and drink by myself.
Oh, that's depressing though.
I'll be coding. It'll be kind of fun.
Okay,
I'll drink and drive.
fair enough.
Uh, I'm not gonna go get Fent. That's not my jam.
Go outside and get some tea. Okay, anyway, that's enough of the stream for today. Thanks for coming on, Dork. I appreciate it, man. Good talk.
Thanks for having me, bud. Take it
Later.
easy.
All right, guys. Thank you so much for you guys that signed up. G Square, Cobra, Travis. Thank you so much. I appreciate it. Hit me up on the Discord if you guys need me to get you added to the country club. If not, you might already be in. Cobra, good to see that you got another credit card going there, or you accidentally bought Pigeonwheel. I don't know, one of the two. If you guys have any questions, I should be at my computer for the rest of the day, so within reason, feel free to reach out and ask away. And I'll have Pickles picks out tonight, and I'll see you guys tomorrow morning for Market Open. Thank you so much. Enjoy the rest of your weekend, everybody. Later.